absolutely right. I mean, the rule is by the end of the year, you owe the tax on the gains. Right?
Yeah.
So if you were, I own about 30 stocks, of which 5 of them are down, including Twitter, which is down like about 15%. Let's say that's my worst one. So do you take a $20,000 loss, apply to your gains, and theoretically you could buy it back on January 1, right?
No, you cannot.
Well, in 30 years, otherwise it would
You
be
have to
washed.
wait 30 days.
What's that?
You have to buy in 30 years,
30
30
days,
days, otherwise
30
it would be
days.
washed.
It's going to be a regular capital gain, right? It's a regular
Yeah.
capital gain.
Doesn't
Oh.
matter.
No, if it's capital gain, it's okay. If it's capital loss, then you cannot buy it back. Like you cannot sell the stock that you lost to take the capital loss
Yeah.
or realized loss and then buy it right away because then it would be washed.
Oh, okay. Let's say buy it in a month then.
Right.
So I actually think some people would do that because the end of the year does have direct bottom line implications, right? So you got 2 days on Monday, Tuesday to decide, do you just write off let's say you got 30 stocks and you got 5 that are losing, the rest are all positive. Do you take all the losses and just say, that's it, I'm out of Twitter, I'm out of, I think, 2 other ones I don't even remember. Do you just take the loss?
Right.
And I think a lot of people do. They just,
Okay, so the other strategy is, if you planned it right, you could say, look, 30 days before, you say, look, I'm going to sell my loss, but I still want to have Twitter, so I'm going to go buy the same amount of Twitter 30 days before, and then when it comes to the end of the year, I'm going to sell my Twitter. I take the loss, which is not washed. I should still own that amount. See what I'm saying?
Yeah, for
that's it. Or you buy 30 days later. But 30 days later, it might go up.
So in my portfolio, let's say, the losses aren't significant enough to really matter that much.
Right.
So if you even have like a $10,000 loss, it's not like you could sell it and then buy something else.
Yeah.
Let's say you think Microsoft's going to keep going up.
Right.
So I could get rid of Twitter and just buy Microsoft and just hope for the best and assume that, like I predicted, by the way, Christmas sales highest in history, right? 3.7 whatever % higher than ever.
You're talking about just broader markets in general?
No, like in my opinion, every consumer company, Target, Walmart, Costco, Apple, Microsoft, all of them are going to report spectacular results.
They say they're going to have a great year.
Amazon highest in history.
$80.
Right.
One day,
Right, so you could just say screw it, you take the short loss of that and buy more Amazon or something.
Right.
And what I think is going to happen is people are going to be assuming, people are just waiting for the shoe to drop, like something's going to happen and then suddenly the market's going to lose like 20% or some catastrophic drop, which is very unlikely because the economy's so strong and still strong.
Interest is low, unemployment is low, consumer confidence is high,
So what I think is going to happen, people are going to do exactly what Kay's been talking about, focus more on value stocks. So buy Pfizer and buy Merck and buy profitable companies and get away from sort of the extremely high-valued, speculative companies, and move to put 50% of your portfolio in profitable, stable companies, and get away from the tech, speculative ones. That's what I think is going to happen in January to March.
It could be, that's what they said.
I'm with you there. What you said, Bernard. That's how I'm feeling.
But,
sorry.
But the market, like you're saying, the Santa Claus rally, it's still going, and like you said, Christmas sales were spectacular.
Yep.
Consumer confidence is amazing. Unemployment's incredibly low. And I'll say it looks like Donald Trump's going to win. So I mean,
I think also it depends on is it March or April when the primaries for the Democrats. So if it depends who get elected, who's going to be the nominee, right, for the Democratic.
Right.
So that could also affect the market because there's a chance, right? I mean, let's say for instance, there is a war, right? So people, Wall Street, they don't like that, right? Because they're going to be, they're talking about
it's
fascinating. That's going to although I think if the economy is strong, the unemployment is low, I think Trump's going to get another.
So Joe Biden is saying that the economy is a disaster right now. Joe Biden in his last thing said the economy is in a disaster right now. Just wait for that debate between President Trump and Joe Biden, right? How the economy is a disaster. I can't wait to see that one going. So if Elizabeth Warren was to become the nominee, if she was to win, the market would be a disaster. But you could think that most people know that if she's going to win, it's going to be a disaster, so they would vote for Trump again. Who knows?
But still, it's going to affect the psyche
Absolutely,
of the investor,
absolutely.
right? They're gonna say there is a chance, right? They don't know. No one knows for sure.
For sure, right.
Yeah, so that's why you might pull the market down. So we'll see. I mean, it's just it's tough. It's tough to predict. I mean, last year a lot of people thought, there's gonna be a big correction, and everybody pulled. I mean, I know friends they pulled their money out. They're sitting on the sideline. They just lost the whole year.
Yeah.
Growth.
But remember, like I was saying, that no one ever goes back to the people who made predictions in August that September is going to be the worst month ever, and then October is going to be, oh no, I meant November, and then so like 4 months. If you pull all your money out based on what they said at Raymond James in August, you lost out on a 10% gain for that last 4 months, and it's likely to go up another 2% in January. So. You can turn on all the CNBCs and all the shows, but some idiot who goes on and says that, oh, now is the month that it's going to cave in. They're just guessing. They have no idea.
But look at these people. I mean, all these analysts come and say Tesla is going to die in company and all that. What happened? Now they're all turning around. They said now James Cramer, he's come and says I'm a believer now.
Right.
And all these guys, look, the stock is 430 from was 178 6 months ago. I mean, it's amazing.
Yeah, the amount of
178,
money.
they were saying, the analysts were saying Tesla's going to go to $10. Based on what?
Well, there's a
I
lot
have
of.
no clue. I have absolutely no clue.
The amount of billions
It's just fashion,
lost.
I think. I don't know. They paid bashers. I don't know.
The psychology is you sound intelligent. If you predict the market's going to go down, and you sound like a rah-rah salesperson if you say the market's going to go up. That's what technology does.
The amount of billions lost in shorting, by the way, and we talk about short selling here, is astronomically high. So just be careful if you short anything. You have unlimited losses, right? So there's a psychology that you can't stomach realized losses or paper losses. So if you're shorting a company like Tesla at 200 and suddenly it goes to 400 and you're down 100 grand, now you have to buy it. And just eat the loss, right? The stock goes through the roof. So I mean, short selling is pretty dangerous. Be very careful. Investing what you. The adage of don't invest what you can't lose doesn't apply to short selling because you can lose even more if you invest it. So just be careful with that.
Should we start with this? This is like the doom and gloom type of numbers that we're looking at.
But if you're confused,
U.S. national debt, I think.
just scroll down. It shows the debt to China is actually decreasing.
Debt to China?
Yeah, go down. Okay, go up. Stop.
Oh, this is last week's. I didn't bring this.
You see the debt to China?
I didn't get it. I was asked
Where am I looking?
Right here?
It's not here.
Yeah, left side.
This issue.
Left side?
Yeah.
I don't have it here.
Okay.
Money
Look
creation.
at total deficit and total deficit to China, and that's the only clock that is going down. The third one, 1, 2, 3. That little left. Little left.
Oh,
there.
Gotcha. That's the only one going down?
That's the only one that's going down. Everything else is going up.
Interesting.
What's his name?
Why?
Wow.
Because our trade deficit to China is going down.
Household assets,
Right.
corporate assets, small business assets. It's really interesting. U.S. total national assets.
Actually, this is so mesmerizing. I can sit and watch this. What's wrong with you? What are you looking at? What are you staring at? There's so many numbers, right?
So what they do with this, right? They figure out what it did the last 6 months. They average it for a second, and then.
Correct.
Oh, okay.
Yeah.
So it's not like live.
Hey, welcome guys. First time, I'm guessing? Okay, welcome. No, you're not late. It's just people are having a good conversation, so I kind of let it go until,
Hey, we need a crystal ball, man. What's happening in January?
Okay, all right. I'm going to give my take in January today. Let's see. So last week we talked about forms of defaulting, and I don't know if you guys recall or understand the logic that's kind of in my head, but it always goes back to the market structure. At the top we have the sovereigns, and then the producers or enterprise, and then we have let's say consumers at the end. Let's keep it simple. Consumers, and then over here we have producers, right? So we all know what a producer default and consumer default looks like. If you default as a consumer, you go file for bankruptcy. Same thing with a corporation, you liquidate assets and stuff. But what I think last week we were kind of talking about was what does it look like when a sovereign defaults? Because they can't really.
It depends on which sovereign.
Like if you're Greece and you're part of the EU, then what happens?
Yeah, so typically it seems that a default results in accumulated debt or depreciation of currency. That's their form of default.
Depends on which country.
Yeah, so we're the platform, we're the Salesforce of the world, right? The US is the AWS of the world. Everyone has to play on our platform. So can we, how does the tier 1 platform default?
Print more money.
Yeah, so the other one would be a, pre-doomsday scenario and then doomsday scenario that we talked about.
That will happen in 50, 60, 80, 100 years from now.
You think so? You think the legal system will collapse?
No.
itself.
Yeah.
So as long as you have a military and political hegemony,
Yeah.
which the US has,
Yeah.
nothing will happen to the country's debt.
Yeah.
The moment it goes down, somebody else comes up, then we'll have problems.
Yeah. So there are bets in Russia and China teaming up to kind of do the whole one belt one road and oil trading and Chinese currency and all that. That's becoming a concern, right? At the same time, in the U.S., in our area, we're ever increasing our debt, printing money, interest rates are lower than ever. So that's the current financial or global macro profile. And as investors, we have to kind of determine how we're going to play this. So every week I've been checking, and you guys have been following me, every week I've been checking the Fed balance sheet and just watching the accumulation of the central bank assets, because now you guys understand the two butt pockets of the government and the central banks. That's how they print money. I don't know. You found that pretty funny, huh, Joe?
Well, assets, butt pocket.
Okay, all right. Well, yeah. So I've been just watching this ramp right here. They've been really accumulating, and so the markets have been really propelling to new heights. I just again think that's really fascinating. Again, we were analyzing the slope, why so steep, why so fast in a short period of time, what type of fear is out there in the market. So again, the repo spike, they didn't want that too high, because if that was too high, it would have caused interest rates to be really high, which we didn't want. Anyways, yeah, there's a lot of exciting stuff in the marketplace. For today, what am I going to talk about? Well, maybe a little intro, since you two are new. First-time investors or long-time investors? Or
First-time investors, actually, my name is Chris. Hello, everybody.
Hi, Chris.
I'm originally from Washington, D.C. I just moved here recently. Designing and building data centers for clients.
Dude, that's so cool.
Contractor,
Yeah.
so,
Hey, I didn't mean to put you on the spot. You kind of just did an intro, so I was like, all right. Yeah, I never do that to people, but yeah.
And that is the biggest water bottle I've ever seen.
Oh yeah, that's my goal every day. One of these.
Water, right? That's awesome.
Yeah. So I was thinking maybe another 5 minutes, but if you guys want me to look at any stocks real quick, just to kind of give you a taste of what we kind of do in here. Sure, what you got? Rite Aid. So you really like that one. I know you talked about that one last week with me. Is it RHT or R? I forgot. RAD.
I think you reverse, right?
I don't know. It's very, so from this type of charts to me, it's telling me that it's very event driven. So I haven't been analyzing Rite Aid, but maybe there's a merger story or something around that.
No, I think they did have a profit for like 5 years now.
Or they finally turned a profit.
Yeah, so
And the market's really reacted. That's
yeah,
aggressive.
It's just from $20 to 22.
True. That could be a short squeeze, right? What's the short float on this? Shares float, short float 26%. So it was heavily shorted. They turned a profit after several years. Looks like back in 2016. Yeah, I mean, these type of charts to me, this is different, right? Typically, this is something that what a penny stock would look like, but this doesn't fall into penny stock category because it's worth about $1 billion in market cap. I know before that, down here, it was worth about 500 million or 600 million. But my take on it is basically, if you get a parabolic move like this as an investor, and you understand, every investment position takes some time to build out. When I see a parabolic move like this, if I'm in it, I'd probably take it already somewhere here. That's my style. That's my conservative style.
I'm with you on that.
Yeah, like anything that moves like a Tesla. I know you got a big position in Tesla in the back. Like if it moves something like that,
Only for 2 to 5 years.
Oh, 2 to 5 years. Okay, well, I think there's gonna be some short-term pain. So, so I mean, that's from my personal trading perspective.
That's absolutely right. You buy a stock at 8 and it goes to 16 in a week.
Yeah.
You go to frickin' dinner,
Like,
man. I mean, you hit the gold, you win the gold star, 100% return in a week. You should be the Nobel Prize winner for investing.
Yeah.
You're getting
So
that.
psychologically, mentally, it's very hard to do, but I try my best to just look at the numbers. Like, okay, it went from, like Bernard said, 8 to 16. Let's take it. Let's take it off the table. Yeah.
Absolutely.
Take it off the table, and then if it pulls back and you still feel bullish, then get back in. But it's very oversold. These type of conditions I rarely see. So when I see something like this, just by analyzing the charts, it's telling me it's very event driven, and I want to analyze the story around this.
So one other strategy.
It looks like a merger, but not really. Because if it was a merger real quick, it would gap up and it would just kind of like just go like that. That'd be a more of a like carbon black merger, right? Or acquisition.
So one other mental thing you can do. So in that case where it goes from 8 to 16, you sell half of it. And the reason you do that is because if it goes up,
take some profits.
you still feel good. Hey, at least I still have half of it. But if it goes down, you feel like, well, at least I sold half of it, so I didn't lose. You know, so you kind of, no matter what, even though it really doesn't make sense, you kind of feel like, well, no matter what the stock does, I'm still going to feel good.
Yeah.
That's one way to do it.
Yeah. So I would take some profits on this. I just think it's overstretched, and your emotions might override your rational ability to make a decision. But if you play this game long enough, you get pretty, I don't know what's the word, jaded, or you just kind of get used to it. And so when I recognize something like this, I always try to either take some profit, like 50%, or just take it off and then get back into a retracement. So that's currently how I feel about Rite Aid.
Also at the bottom, the stochastics are intersecting, so that's also a good sell point.
Yeah. So everything is just, I mean, all the indicators are overstretched. Like this is categorized as event driven. You know, there's something about this going on that you have to understand the narrative. Not so much like you can't really play you can play the technicals, but the markets are just too wild with these swings. So that's my take on Rite Aid. If you ask me, we might not get to it today, but you know, I don't know if I feature every stock every week, but this week I did a lot of analysis with gold miners, energy stocks. I'm getting really bullish on energy stocks. Again, educational opinion only. And then for one growth stock that I'm really interested in, it's this one right here. It's called PagerDuty. I don't know if you guys know, but how did I come across this? I just started reading SEC filings, and then I realized that, two really big players are in position in PagerDuty. One is, it's not Sequoia Capital, it's Bessemer Ventures, which I highly respect, as well as the other one, which is, Andreessen Horowitz. Right, they have significant positions. So they did a $30 million VC investment, and now one of their portfolios, Andreessen Horowitz portfolio, is $300 million. You see why venture capital is so hot? Like you could deploy $30 million and get a return of like $300 million, and at the peak of the portfolio it was at $600 million. So they were up like $500 million off of $30 million. Now knowing how this IPO'd, if I were to do a quick IPO analysis, it IPO'd at around $40, right, and it had an IPO pop. But later, you know, after 1, 2, 3, 4, after 4 months, it broke its IPO and it got to a new low. Typically, when it goes to a new low like this, it'll go even lower. So I like it now because, again, I know most of these venture capital-backed companies, software companies like this, typically go into the market like Uber and Lyft at overvaluation numbers. So I don't want to buy that. So I want to wait until there's blood in the streets. And I think there's a decent amount of blood in the streets now. I think it could go lower, though. It's still in a downtrend. It could go down to $17. I like to get in at $17. But when I'm looking at the market cap and the quality of venture capital holdings, it really convinces me to say, okay, maybe a starter position right here makes sense. But I really want to size into this position because it's only worth $1.8 billion in market cap. That's really small for an enterprise software company. So the current value is 1.8. For those of you who are really strong on your fundamentals game, you're going to say like, well, this software company makes no money, like every other software game. It's really, these assets to me are more perceived as corporate strategic assets, right? Again, I'll say corporate strategic assets, meaning entities like Apple, Facebook, Google, whatever, right? These type of companies funded by Sequoia Capital, Andreessen Horowitz, Greylock, whatever, tends to become strategic assets of major entities, and these entities will pay a premium. So I'm very understanding that they don't pay anything, or I'm sorry, they're not making any earnings, but they do have sales, and it looks very attractive because it's trading at a price of sales of 11, which is almost at fair market value. Fair market value to me right now is probably 15 to 20 in that range. So it's trading about, you know, five units below fair market value. So I like this one. Gross margins are pretty. Say again?
What kind of middleware are they into? I mean,
Yeah, so what they do is basically today's, what is their business model, right? The evolution, if I recall correctly, the evolution, so this is more B2B software. You have to really understand software to get this space, but what it does is basically today, the IT division, with the increasing of like Slack, Workday, you know, Cloudera, whatever, so many software out there sending IT alerts. And so they need to consolidate these alerts into one platform. It's kind of like social media today, right? We analyze the consumer segment. We got like Instagram, LinkedIn, TikTok, all that. There's so many channels. I'm getting all these messages. I wish I could just have like one command center where I could just interact with everything, like a Hootsuite, right? But I don't leverage that on the consumer side. So this is the same thing, but more for IT indicators that come from many applications that surround the enterprise segment today. So modern leading corporations, again, if you look at stocks long enough, you'll understand that something like oil and gas versus something like a PagerDuty here, or a Cloudera, or a Slack, or Workday, there's a difference in terms of age of entity. These are the new breed of entities. And so the new breed of entities have a higher valuation premium, and so we have to understand that to kind of price ourselves in, right? Or to take a position. So today I think it'd be an interesting day where you're going to see me go from oil and gas, which is like deep fundamental value. Warren Buffett's going after oil and gas right now. But then you're also going to look at something like this, where it's like high growth, you know, leading bleeding entity at the edge of technology, whatever, that has a lot of upside, but also a lot of swing, so you got to be careful. So that's how you get two flavors, right? You got like a robust dividend play with industrial assets versus a high growth. How do you position that into your portfolio? Something like this, you might allocate like less than 1%. But something like that oil and gas, you could easily go 5 to 10% of your portfolio, your net worth, right? So if you're worth 100,000, you could go 10K. Yeah. So speaking of Warren Buffett, right? He's going after this security. So I'll show you just compare and contrast. He's going after this security called OXY. Business is Occidental Petroleum. I found a better oil and gas company, in my opinion. I think it's called, ticker symbol is ET, Energy Transfers. We'll look at that. So I'm looking at, this is Warren Buffett's recent position, right? Why is he buying this security? It's paying a 7.87% dividend. That's a lot of dividend, right? And it's becoming profitable, and it's oil and gas, right? Independent oil and gas, and it has sales, existing sales of $17 billion. I know the margins are pretty thin, 5% margins, but it's profitable, but this is more of that robust jump to value when markets are uncertain. So markets today are pretty pulled up to the upside. As you saw, S&P 500 has been climbing for like the past several months of money printing. But money printing is starting to help these distressed assets kind of bottom out. So we're seeing a little bit of bottoming in like oil and gas, and I'm getting really, I don't know if I want to use the word, but I'm getting a little greedy in the oil and gas segment because it's looking very attractive.
What do you think of price to earnings for this segment?
Price to earnings for the segment, I actually have that number. It's part of the discussion today, but if I could show you real quick. The energy sector, right? Whoever asked me to...
This was 28, so is it high?
So I'm sorry, what'd you say?
So the stock which you showed OXY had a PE of 28. So how does that compare?
Yeah, so for this one, I know it's a little bit different. I wasn't really looking at the PE for, are you looking at energy transfers or Occidental?
OXY.
Yeah, so for OXY, right, I wasn't really looking at the PE. I know PE is kind of like at the market, 28 is pretty high. Now, keep in mind, why is it high? Well, if we're anticipating a global macro event where they're going to devalue the dollar, it's going to cause oil prices to go up. So if oil prices go up, that PE is going to go down. So let's not look at the PE because I think the PE is not showing what is the potential of oil prices today, commodity prices, because it's highly sensitive to oil prices. What we want to look at is price to book value, PB. It's trading close to its entity value. So something like Warren Buffett, he doesn't want to buy overvalued securities. He likes to buy something at the value. So the net balance sheet value is about 30 billion, let's say. So he's buying at 30 billion, and I think from his view on this, right, seeing that there's some earnings now that's kind of growing, as well as stable sales in the past 3 years, he sees that 7.87 is an attractive dividend for a blue chip $35 billion entity. Yeah. So this is an opportunity that I view as well with Warren Buffett that we could position in at 5% of portfolio, right? This is educational opinion only. 5% of portfolio at $40 in anticipation that later it could go up to $60, but until you wait, it'll pay you 7.87% dividends.
Spot on.
This is an incredible opportunity, so I'm getting greedy over here from a deep value play. Now, I've identified 3 that I really like. If you're really lazy and you just want to play a diluted play like an ETF, then you can go with something like a OIH, which is another one I'm looking at. So this is an ETF that covers everything midstream. So in oil and gas, it's like how I tier out the segments in the market segments, right? You got your sovereigns, your enterprises, your consumers, etc. In oil and gas, they have upstream, midstream, and downstream. So upstream is more like exploration, right? They go out there and they dig and with the pipes and all that. Midstream is more like pipelines. So that's more real estate assets, right? Because these pipelines have to exist for the oil to move around. So again, what happens when we print money against real assets? Home prices go up. Well, this is industrial real estate. So when I look at the midstream, it's real estate versus when I look at upstream, it's more exploration, like gold, like the gold miners where they go out and just hammer the mines or drill the mines and pull out some gold, right? So I'm not doing exploration, but you can. That one's more leverage because it's all based off oil prices, right? Again, I mean, the reason why I'm getting really excited is that we've been talking about this money printing action for several weeks now, right? You've seen that they're injecting money into the system. And when they inject money into the system, you go over the currencies and you look at the dollar, you actually see the reflection of that right here. So you see the dollar right here? So in the last trading day, it actually reflected some downside. Better yet, if you use the dollar proxy ETF, so this is an ETF that tracks the USA dollar, it's broken down the 200-day moving average and just falling like a knife right now. So the dollar's really getting hit right now, which is good for the rest of the world, especially good for emerging markets. So in terms of like opportunity that I'm seeing a lot of opportunity in energy stocks that are beaten down, that are paying high dividends, as well as high growth emerging markets. And GMO, a leading organization, also believes that that's a major opportunity in the next 7 years. So if you look at this, we already looked at this before, but 7-year asset class real estate, real returns forecast. We're talking about real returns. They're seeing emerging markets as the most bullish segment. Why? What's propelling emerging markets? What's good for emerging markets? A lower dollar, right? So a lower dollar is also good for gold, good for oil, good for emerging markets again. So, but now I like the enterprise software segment. That's just a completely different animal. So the analysis is completely different. But I hope you guys saw that quick compare and contrast, right? Between Oxy and then between something like this. This one has no earnings. But what's the difference? The entity's bleeding nature, technology nature. This one is leveraging, like it's using Workday versus like that Oxy's probably using Excel sheets or pen and paper or whiteboards. Right? But they have legacy money, which is like 17 billion in sales. This one's only 100 million in sales. So the assumption is that, well, if commodity prices appreciate and these guys, the next demographic of industrial oil and gas people come in, they're going to start buying software like PagerDuty, right? Or at least if they buy more software like Slack and Workday and all that, then they're going to have a lot of alerts and then PagerDuty is going to do really well. So see, how, as an investor, how do you balance your portfolio now, right? This is a high growth opportunity, but then you got that value. So it's up to you on how you want to.
So, Kate, if I can just say, I actually think though that people are going to be more cautious in January through March, and not to say anything negative with this, but people that own stocks like this are going to be more inclined to look at a stock like Oxy as gasoline's here to stay, energy's here to stay, lots of unknown in terms of tech overall.
Exactly.
So look at this Oxy stock, 7% dividend on increasing earnings, and Warren Buffett's the best, etc., right? How wrong could you be if you load up your portfolio with 30 companies that have increasing sales and earnings and pay a dividend? If you shift, let's say, a quarter of your portfolio away from tech into that, no one has a crystal ball, but you probably are reducing your overall risk by doing that.
Yeah. So does anyone know what the markets are up for the year before I show it?
Oh, it's got to be close to 32%.
Which index?
S&P 500. So here's the S&P 500. We're skipping ahead, but 30%.
That's incredible.
S&P 500 is up 30%. When was the last time something like that was up 30%?
The green one, which is 2013. So what happened the next year in 2014? 2014 next year, is it this color right here? Yeah, it is that color. So next year it did about 10%. So what happened in the first quarter of 2014 the next year? First quarter right there. First month, I mean. So the month of January sold off. So if you ask me about my crystal ball moving into Q1, I'm going to get a little defensive and bearish.
Yeah, but don't forget, by the way, though, this is a bit deceiving because the market went down in October through December of the previous year. So the up 30% is really not 30%.
Exactly.
If you looked over a 24-month period, it's a little bit more meaningful.
Yeah,
right?
You're right.
You
So,
know what I mean?
from a 24-month perspective, I'd probably say we went from here to here. So, what was that? If anyone knows the number, like 10%.
It's still up a lot, but if you looked if you looked up 15 months from October 2018 to now, it wouldn't be 30%. It would probably be closer to about 20-ish%, which is still spectacular.
Yeah.
Right?
Yeah.
I mean, 20%, if you get a 20% return on
Yeah.
your investment, you're doing better than any Morgan Stanley fund in the world, right?
Big time.
So you're
Big
doing
time.
incredible.
They're just salespeople.
Exactly. I mean,
I used to be there. That's why I know.
yeah.
Yeah, so, but the other thing I want to say as well is like, you're right about how if you measure from this top, and that's the real return, the real new net return, whatever.
Right.
But I'm also a big believer that one shouldn't be selfishly biased against the realities of the world. Okay, I'll give you an example. When I was a kid growing up, I used to, when my parents take me out, I would see, this store, grand opening. Okay, I think I told you guys a story before, but basically, the logic is, why? Like now that I think about, why would we have a grand opening when markets are always moving? Meaning every day someone's graduating, right? Someone's being born, someone's dying. Markets are always live. There's no such thing as a grand opening. Grand opening is more of an internal facing, more of a selfish bias, in my opinion.
Yeah.
Versus like, if you're completely aware of how markets operate, you wouldn't do a grand opening. I wouldn't do an EnterpriseGuy grand opening, right? I would probably go, okay, markets are live right now. I'm going to hammer some phone calls because I know markets just have to happen. People have to buy a home today. People have to sell a home today. It doesn't matter. It applies to all market segments. So if I were to sell software, sell whatever, you have to be objective focused. So applying that same thought, right? Not being biased about grand opening because that's more of a internal. I view it as a selfish thing. If you pay attention to just objectively looking at markets, just imagine, when did this money manager come into the industry, or how the money managers are looking at the markets? They're just looking at beginning of the year, end of the year. So in terms of that, beginning of the year, end of the year is 30% performance. But looking at the other angle, it might be a little biased, but it's not a problem either. That's good to kind of analyze like net new performance. We have a chair. Okay, he's got it. Anyways, markets are up 30% for the year. So I think just based off that simple logic, it's up 30%, maybe Q1 2020, let's get defensive. Let's look at these value stocks, right? I think if we pull back, they'll probably print more money. If they print more money, then I think these industrial real estate assets are pretty good. Because a lot of people come to me today, right? They want to buy a home, but it's like, markets are pretty expensive here, right? It's 11x, it's Silicon Valley. It's where all the 80% of the unicorns are located here in Silicon Valley. So you have to pay this premium. What was I going to say? So, oh man, I just lost my thought. We'll circle back. Yeah, so just be mindful of. Okay, I remember now. So they want to buy real estate, consumer real estate versus industrial real estate that it's live in the marketplace today, and we have access to it publicly traded. It's just there's deeper value here, right? That everyone's afraid. So there clearly is blood in the street. So another oil and gas company. We are kind of skipping ahead, but I just want to show you the oil and gas companies that I'm looking at. Energy transfers, right? So this one I think is a better pick than Warren Buffett's pick. Now that sounded really cocky, but I just think it's better because they historically have more profitability compared to the other one, and they have bigger amount of sales. But the beauty is that they're paying 9.39% dividends.
Wow.
Right? And this is the same size as the other one. And this one is more midstream. So this is more infrastructure.
And the gross margin is better.
Yeah, okay. What was the other gross margin? This one's 26, the other one was...
That was in the teens, I think.
Yeah, okay. I think they're both taking home 5 though. But this one's doing a lot more sales. But closer to the balance sheet, the other one's closer to the balance sheet.
True.
So he's looking at 1.29, but PE ratio, this is probably where you're like, oh, this one looks more attractive. But you know, knowing the PE ratio, right? Again, this probably looks better because if oil prices were to go up and this makes more money, the earnings would look better. Then PE would go below 10, which will look even better. So I think they're both good as blue chips, right? This is more of a robust defensive play, store of value. From a technical perspective, Oxy is still in a downtrend. This one's actually fighting the downtrend, where you got kind of a higher low right here, right? You got the low right here, the low, now you got a higher low, and then you got some parabolic move right here. So you have some interest, because at one point down here it was probably paying like 10, 11% dividends. So as they buy it up, the dividends go down, because they want to lock it in, right?
Is it a good point from technical understanding?
From a technical analysis and dividend, so this is a different type of business, right? It's not enterprise software. This one has a dividend and it's profitable. So I stack my technicals with the profitability, but also my investment time frame has expanded broadly. So from the technicals, I think it looks good at 9%. Even if it goes down further, I mean, you could do like a starter 25%. Let's say you're going to do 5% portfolio allocation. You could do 20%, which is 1%, right? 1% of your 100%. And just do a starter. If it goes down lower, you could lock in higher dividend pay.
So if you could briefly discuss, I mean, this information as to big players like Warren Buffett and big guys are investing. So if they invest, they stay longer, or the next day they sell it, or how does it work, or how credible is that information?
How credible is the
Information that these big companies are buying, and if when they buy, generally they are day traders or they are long holding folks?
Yeah. So I'll give you an example why energy transfers look really attractive to me. If you dissect, for those of you who don't know, this is Guru Focus. I pay about $1,500 a year for this one, so it's really I rely a lot on the data here. Okay, it's really nice to see that if I were to jump in here, right, and keep in mind the type of holders of a security. There's a public, I mean, there's a direct inside executive holders and then institutional holders, right? From the inside, I like the fact that this executive right here, Kelsey Warren, he or she has significant positions, 42 million shares. This is old legacy money right here. But I like to see that they have skin in the game.
They're not a founder or an exec?
This one's an exec.
Has to be, right?
Yeah, he's an exec. Kelsey Warren of Energy Transfers. Energy Transfer. So this one is he's a 4.2 billionaire, 64 years old if you want to know.
He's the CEO, of course
Yeah.
you have 50%.
Yeah, so CEO. So sometimes a CEO would have 1%. Right? So this is a scenario where I like the fact that this is a CEO who has skin, really a good amount of skin in the game.
Yeah.
Right? If you want to calculate how much is 42 million shares times it by the price, that's how much he's positioned in.
I bet that Ray Davis is another CFO probably, right?
Yeah, something like that. So again, you see the holding structure of these companies are completely different from a software company. Software company is like, it's so, like these guys will hold significant shares, but a software company would be like kind of sparse. Unless it's like Larry Ellison of Oracle, who holds like 1.1 billion shares. He was like, for like the past 6 months, he was up and down 8 billion. 8 billion in 6 months. That's a substantial amount of money. But anyways, going back to energy transfers, right? So I like the executive lineup right here. How the CEO has 42 million shares. That's, I mean, if you're going to buy 1,000 shares, and just think of this guy, right? Yeah. So I like that, but I also want to see what other publicly traded hedge funds out there that have significant shares of this company. So of their asset value, like who out there is willing to bet high conviction? So I'll swing over to the Guru Trades over here, and just look at who are in position. So let's see, go up to plus, and then go over to share. Not shares outstanding. I want to see percentage of their assets. So there's this Delphi Financial Group. Okay. They're willing to bet 27% of their portfolio. Even Walnut Private Equity Partners willing to invest 24-25% of their portfolio. So we could open it up and see what else are they investing in to kind of get a comparable. That one was Delphi, so we'll open up Walnut real quick. So let's look at their portfolio. So this is actually this person's biggest holding. They're managing 293 million. Managing 293 million, and that's their biggest holding right there, Energy Transfers. That's a value play. See this? I mean, I think after today, anyone could probably become a money manager. Right? Just the trick now is like, oh, you see the investment? How do I go and raise 293 million? That's the sales part, right? it comes out of network. It's a function of network. But yeah, this is very fascinating to see like what else are they positioned in. If we observe this portfolio and look at the sector weightings, oh, it's not loading. Okay, I guess I'm not getting data. This is okay. I'm not getting data for that one. Let's try this one. Okay, so this is a different one. This one's managing 99 million. Also, the biggest position is ET. Looking at the sector weightings on this, oh, it's not showing today. Might be data issues on my end. And it's not showing the shares. Okay. I guess I can't do anything about that. But basically, yeah, it's just, to me, it's good to see that someone managing anywhere from 290 million to 99 million for this one holds such a significant position in energy transfers.
So they seem to be focused primarily on energy, right?
My tools aren't working today.
Like MMP and Sun and...
Yeah, let's look at that. So it could be other things. So I mean, this is just one portfolio, right? Not every portfolio is the same, but MMP is also oil and gas, midstream 6%, trading at a little bit over book value, but PE is pretty low. Price to sales is 4.9, but this one's always been profitable. It's never been unprofitable, and this is oil and gas pipeline. So pipeline, again, mimics real estate. So to me, again, if you print, the charts look pretty good. I don't see a breakdown below 60. If it's a breakdown below 60, it could go lower to like 50. But it's paying a 6% dividend, and earnings has never been disrupted in the last, since 2014. Even when oil prices took a really big hit in 2012. Oh shoot, I forgot the date. So looking at oil prices right here, that company, yeah, 2016 was the low of oil, right? So that company, going back to it real quick, MMP, in 2016, their lowest was $60 when oil was the lowest. So in a way, that fund has taught me that, okay, maybe that they have identified a bottoming in the technicals, as well as a 6% on value assets under a very uncertain global macro environment where dollars to be expected to print because the sovereign profile is just really bad. I think it looks great. So yeah, that's the shift between oil and gas and enterprise software. This one's becoming attractive, but this one to me is probably from a conservative perspective, I wouldn't allocate more than 1% of portfolio to this. So you want that 1 out of 100 try. But if that 1% does really perform, it could grow to like 5% of your portfolio. So that to me looks really attractive because it's only 1.8 billion. In the enterprise software world, 1.8 is nothing. This is probably going to be like another Carbon Black. If this remains in the market long enough, someone will acquire this like a Splunk. Because they do IT. Oh, are you familiar with this company by any chance? Mm-hmm. So you think Splunk would acquire it too, or?
Possible.
Possible? Yeah. It's very cheap. We could always go over to Splunk and see how much they have on their balance sheet to see if they could acquire it, right? Let's see. They probably. I know. Well, maybe not. Maybe not enough money to acquire. But someone out there would be attractive to the security. If I were to show you the VCs that are behind this, pull up PD real quick. PagerDuty. Your voice sounds familiar. Were you on the call like 2 weeks ago or 1 week ago? Yeah. Were you the one to ask me about the cloud software segment? Yeah. Oh, that was you. Okay. So who was the person that recommended you? Just out of curiosity, if you don't.
No, I just joined through Meetup, man.
Oh, okay. Well, hey, welcome, man. Welcome to the investment club. So real quick, if I pull up PagerDuty, right? Again, I want to look at, let's say, the inside owners. Again, I'm stacking layers of analysis here. I'm stacking technical analysis, fundamental analysis, technology analysis, strategic asset analysis of major corporations, several layers of analysis, but it's really good to see that this person right here has 3.7 million shares on the inside, but the biggest holders on the outside are these two right here. And this is why this week, to me, it's sort of my highlighted, really interesting play. You guys know who AH is? You guys know who AH is? AH Equity Partners? Andreessen Horowitz? This is Andreessen Horowitz. One of their portfolios, right? Portfolio number 3. They're only holding 3 securities. This one's Facebook, but they're holding Lyft. That's very interesting. So now I'm getting other ideas, like they're bullish on Lyft, as well as they're bullish on PagerDuty. So PagerDuty is a significant position because it's 600 million of their money, okay? And they're betting 50% of it. That's 300 million from the guys up in Sand Hill Road right here. They're not too far from us.
So if this is their third LLC, what are they doing? They are kind of taking all their investment and splitting it up into
Yeah.
multiple other.
Yeah,
securities
so-
and reducing the risk.
Yeah, so in the venture capital world, it's a little bit different compared to public equities. Public equities, like, it's public, like a public bathroom. Anyone can use it, right? Or a library. I shouldn't use the library example. But for private equities like this, it's, again, it's all network based. If you want to play the game, you need to build out the network. So that's going to be my efforts in the next decade, because we're moving into a new decade, which is kind of cool. Next year, yeah. So it's private. So you have to create the network to get some visual on the marketplace. Because all this data right here, we have the luxury of technology to give us that visual. So we don't have that type of visual. So what happens is in the venture capital world is they'll go and raise some funds, and it'll be like, okay, fund number 1 will raise here, fund number 2 will raise here, and then that fund number 1 will invest into this I don't know, this pool of securities, and then they'll raise the next fund off of some gains or whatever, and raise more and just keep going. So they could go up to like fund 9. Yeah. So this is one of their funds, and it's grown to 600 million, it looks like. So what happens is that, let's say you, as a venture capitalist, right, you invested 30 million, which is what they invested, and it became 300 million for PagerDuty. That's 600 million total, but I don't know. So
the turnover is 0%, so they're not buying and selling; they're just investing into it.
Yeah. So what happens if, like, you invested and it goes public, but you don't want to sell it? So now that has to become an account of its own to take on all the individual risk. But I like the fact that they have 50% of this portfolio or significant holdings of a company. It's only 1.8 billion. In the public markets, that's really tiny. Remember I told you the vast majority is like 30 billion? Like I'm sorry, not 30 billion. 1 to 20 is like the vast majority of company values out there. I don't even want to say 20, like 1 to 15, yeah, okay, 1 to 20. 1 to 20 is the vast majority, like out of let's say 10,000 securities, 80% is 1 to 20 billion, right? And if that falls into 1 to 20 billion, then equity research is a very powerful skill set to have to analyze the trajectory of the security. And I think this one could really 10x. Educational opinion only, okay? 10x meaning it's trading at $23. I think it could go to $10 billion, which is $230. I know, right? Yeah. So, but because of the nature of non-profitability, no earnings, only sales, it's really at the hands of the salespeople of the corporation. How good those salespeople? If I were to tap into, if I was a VC and I was to tap into the salespeople, like, who's your sales team? I start analyzing their network. Like, how many people does this guy know? Oh, how's this one outperforming? Like, oh, they're in the IT division for the last 20 years. Okay, that's a really good human capital right there. So that's how I would further analyze it. But because, well, it's public, I don't know. I don't think we could go that far in analysis, but it'd be great. But anyways, looking at the technicals, I do see some people fighting the bottom right here. There was a recent earnings right here in December. It gapped down, but look what happened. It retraced. But that retracement, the $25 acted as resistance. So what I'm looking at this point is, I do like the fact that it's in a falling wedge pattern right here, right? Because typically after that, it'll bounce and it'll be bullish. But what I want to see for a buy for me is above 25. 25 appears to be that critical price area in this near term that these near-term participants are in agreement with. So if it could go above 25, I'll position some calls in there. But if I'm really desperate and fearful of an acquisition by another player like Splunk, if they had money, then I would probably position right away, no questions asked. But I wouldn't go more than 1% portfolio, because I want to defend my portfolio, right?
Who's their biggest competitor right
I think they're a Gartner leader. The biggest competitor is another private company. It's not public yet. It's another private company called something Panda.
Big Panda.
Yeah. Oh, you're really in that. You're really in that. You're in IT, I'm guessing, huh? Yeah. So yeah, Big Panda is a competitor. I think Splunk is a competitor as well, but maybe not a pure competitor, right? Because they have several solutions. Not all.
No, they're more on the security side.
And
Splunk is more on the security side.
I see. Would it be like? But then they also fall into search? I forget. Security and search.
They're getting into it.
Gotcha. So another way I identify opportunities is because I learned it at Morgan Stanley. This older gentleman who used to bike in like commercial parks, and he said I would just invest into like whatever nice looking commercial real estate. So if he biked to Santana Row and saw Splunk, he'd be like, I'm gonna buy that one. And he performed really well. So that's something that I'm really curious about, because the more that I drive around Silicon Valley, I actively drive around Silicon Valley just to kind of gauge the commercial real estate. And I realized, like, you know, the companies like Forescout or NetScout, there's a Forescout, NetScout, F5, they have really nice commercial real estate. But when I look at their financial profile, like a Splunk, they don't have money. So I'm just wondering, like, there's this tight group out there in Silicon Valley that's just giving them, like, hey, you deserve this best, you know, Silicon real estate asset because they got all the venture players and all that. So my thinking is that if you really dive deep into this segment and just figure out the players in the ecosystem, you're very likely to also, what I'm trying to say is that if you go deep into the venture capital, you're very likely to meet the top commercial real estate players as well, and other players like marketing, et cetera, et cetera. Interesting stuff. That's my suspicion, but I'm nowhere near there. So in the meantime, I invest right here. So that's the highlighted security that I feel suspicious for the week. I showed you Andreessen Horowitz portfolio. This is Bessemer right here. Deer, I know it's Deer V3. You wouldn't know, but if you do a Google search, you'll see the word Bessemer somewhere. Oh, Bessemer Partners V3 Institutional Form 3 file. Deer V3 Co. Interesting, right? It's interesting how we could just figure out these players by just doing some analysis. Yeah, so for Deer or Bessemer Ventures, they have 39% of the portfolio, managing about 250 million. The other one is Twilio. A lot of people really like Twilio.
Absolutely.
Yeah, that one's a big hitter. It seems to be a disruptive player in the enterprise software segment. I personally like the price right here at 100, so I have some calls on this one. But this is a starter position because this, again, I'm anticipating in January Q1 it's going to be quite volatile because the market's been up so much, but this one's been down. It might get tougher. This one might go sideways, but something like a Twilio, it just seems that there's a lot of strong players surrounding the security that I can't look away. If we look at the venture capital players of Twilio again, like who were part of this, if I see a strong mix of VCs in, I get really more, I have more high conviction for it. So looking at this,
if you like Twilio, you should look at Vonage, by the way.
Is Vonage, that one's publicly traded as well, right?
It's trying to become a Twilio. If you look at
I
the
remember,
valuations,
yeah.
they're kind of out of alignment in terms of revenue and earnings.
Yeah, so they're definitely out of alignment, but I remember looking at the security. So this is Bessemer Ventures' favorite product. I remember Vonage. The difference is that Vonage is not a pure play.
Right.
That's the main difference, because if you, one key thing that gave it away for me when I analyze it, if you look at Twilio, right, if I recall, it was 53% gross margin, but when I go to Vonage, oh, it's also 57. So I just remember looking at this and it wasn't quite the pure play, because it was the category. There you go. So if you go over here, Twilio, right, the automatic categorization of FinViz categorized Twilio as application software. But when you go over to Vonage, this is the one, right? Vonage Holdings Corp. It's a holdings company. It's diversified communication services.
So if you want another one like that, then look at bandwidth.com, Band, B-A-N-D, because all three of those are very similar in nature.
Yeah. So now this one categorizes as software. At least it talks business software. At least looks pretty good.
I think this is a winner. This one here. I think this one's going to go up 50%.
I don't argue with you there. I think the possibility is there. I do see, I mean, it's a profitable software company. What I like to do next is really dissect what is this business model, right? So if I were to go to Bandwidth's website and, okay, see that, okay, it's pretty modern looking compared to like an oil and gas company. And if I go down to investor relations, and pull up a quick report just to see what is it that they do. Oh, I was already there.
It's CPaaS. It's similar to Twilio. You can build apps in the cloud based on it. So Twilio and Vonage and Nexmo and
okay, so they're all competitors.
Similar, almost identical in terms of the space relative to what Twilio does.
Now, when I look at the security and look at the charts, right, I see that okay, IPO'd recently, and this is software, so I'm guessing there might be venture capital players behind this. So bandwidth. So yes. Looks like it is a software play. Software falls into my specialty, but none of these VCs I know of 20 million funding, so not that much funding. Yeah, I would probably want to do more research, but overall I like the profitability of this software company. Typically you don't get that type of scenario, trading at 6, it's pretty much undervalued. You're right. So it looks attractive, but I want to know more before I make any decision. If I had to make a decision, I would invest less than 1% portfolio. In terms of technicals for bandwidth, I do like that it gapped down right here, right? And it sort of set up a V bottom and then consolidated right here, telling me that it's not comfortable at the price of 45. It doesn't want to be at 45. It wants to be anywhere from 50 to 55 and above. So that's what it's telling me. That's where.
I think that one's going back to 100.
Yeah. So if it does retrace back to 55 or 60, that could be a position. But if you're an aggressive positioner, you could get back in, and I do anticipate upside, but some resistance at 75. Is what I'm saying.
Yeah.
Anyways, guys, it's been like almost an hour. I gotta get started on today's discussion, which we didn't get started yet. Yeah.
There's some amenities for everyone.
Oh, you brought some stuff? Hey, thank you, man. It's like every week you guys have been bringing food. I'm just I should try to forecast what's next. Okay, so today's lecture number 146. We're going to talk about a lot of things. We're going to talk about the markets. We're going to talk about volatility because I do anticipate volatility as a potential trade moving forward into Q1 2020. We're going to talk a little bit about global macro and the awesome conditions for gold right now. Gold is really outperforming, I'd say, the markets. And then we're going to look at energy stocks, but we kind of already did. There's one more name that I like in the oil and gas segment that's also paying about 6 to 7% dividend. It's Enterprise Product Partners, EPD or EDP, EPD I think is the ticker symbol. So we're going to look at energy stocks. We're going to talk about inflation's eating your money. That's why we're investors, right? But taxes is also eating the money. So I got to become like a CPA or something. I mean, next year I'm going to put a lot of effort into learning about taxes and just, there's this book, so I try my best not to, like yesterday I was trying to focus and study, right, at a cafe, and then I bump into people. And I bumped into this insurance broker, and we had a conversation for 3 hours. And then I'm like looking at the time, it's like 9 o'clock, and I didn't get a chance to study. Unintended meeting. And at the end, the conversation was so good that at the end, because he was teaching me about insurance and the ability to tax hedge, and seeing the financial profile of the sovereigns, they're going to for sure ask for more taxes moving forward. If not, then they're going to devalue your dollar. So for the most part, I can help you guys protect from devaluation of dollar through investments. Because that's the only way we protect ourselves, because we have to invest based off that. But the other half or the other third of it is the taxes part, which I'm not strong at. So that's something that it's a weakness I'm aware of, but I want to improve on that because towards the end of the conversation with the insurance broker, he gave me a book called The Power of Zero. The Power of Zero, right? and the book is about how to pay zero taxes. Yeah. So I'm excited to dive into that. So I want to learn more about tax strategies moving into next year. There are certain ways that you want to operate to optimize that. And
make $0, then you pay $0.
Sure. So inflation eating your money, and then we'll talk about gold safe haven. So before that, Happy New Year and decade from the Enterprise Guy to everyone here. Cheers to another decade of wisdom. It's been an awesome decade, and we're moving to a new decade. So I figured I didn't know what to put, so I just put a picture of myself up there just to say, chase your dreams. And at least in this next decade. If you didn't do it in the last decade, do it in this decade. Go chase your dreams. So that's what I want to do more of, chasing dreams. And I figure I include Buzz Lightyear's because, reminder to chase your dreams, and then words of wisdom for the next decade is, again, think about this. The year 2000 was 20 years ago. Ooh, when you think about that. I put Buzz Lightyear up there because I was saying, wishing you guys the best of the best today, tomorrow, and beyond. And I was like, to infinity and beyond. And just thought of Buzz Lightyear. So I put, we all need a Buzz Lightyear in our lives. If you watch Toy Story, he's pretty charismatic and quite the initiative character. Plan in decades, think in years, work in months, live in days. Just another piece of nugget that I saw out there that I wanted to share. And then this quote from this, she's a trader, by the way, on Twitter that I follow, but she's always posting like really good musings, so I read it. Old-fashioned habits that make our lives better. Kindness, reading books, politeness, modesty, face-to-face socializing, which we don't really do much of, or for some age groups. Good manners, homemade cooking, eye contact, Long walks. I don't do that enough. Sharing knowledge, listening, fixing what was broken, keeping promises. Anyways, just some initial motivation. Going back to the cool stuff, the real stuff right here. This is a motivational poster, but it's not really a motivational poster. It's more like a reality poster. Inflation, because the easiest way to steal your wealth is by cheapening your money. And it shows like a little mini dollar on hand. So I found that pretty funny, and I wanted to put more humor into the lecture, so that's the humor piece. Inflation humor. I wanted to share some interesting charts that I saw this week.
Talking about inflation and going back to your initial thing, right?
Yeah.
So think about the pound, the British pound.
Yeah.
At one time, £1 was about $5 to $10 at the height of the British Empire, right? That was about 80 years ago.
$5 to $10.
It took 80 years for the British pound to lose that kind of value. Right now it is 1.1, 1.2 dollars to a pound.
Yeah.
So think about it that way. If the dollar is being depreciated, that's the timeline you're thinking about for it to decline over time.
That means that the British were really screwed.
That means what?
The British citizens are really screwed.
Well, they also got their money printed down, right? Because it went from 10 to...
They had power at that time.
Yeah.
Now they don't have that power. Now the euro and the Brexit, it'll go down even more.
Yeah.
But think about it this way. If you're saying that your dollar, of course, is going down in terms of devaluing it, but it still will have power for the next 80, 100 years.
Yeah.
See, all that we look at in here is like, it's just really data. And you're looking back like hundreds of years, and we didn't even live then. But it's just like, I don't know, the more I think about this, has anyone ever thought about when does the stock market end? It never ends. Because after, I'm gonna, the millennials are gonna come up, right? And then we're gonna mature out, and then we're gonna distribute just like everyone else. So everyone has the same roller coaster. It's fascinating to analyze, but you gotta understand there's different regimes in markets. And if you understand different regimes, like a money printing regime, I think investment philosophy is widely different than a non-printing regime.
Speaking of when you clink the champagne glasses at New Year's, just thank your lucky stars, everyone in this room, that you live in the most successful country in the history of the world right now that's likely to remain that way for the next 50 to 100 years. So you could be living in Slovenia or in the UK, which is a disaster, or Germany's a zoo. Instead, we have an economy that's the highest it's ever been. Right? So
and also the beauty of Silicon Valley. Especially
you can worry about aliens taking over the planet before you have to worry about the United States overall. I mean, it's a good place to be.
I think I'm more worried about inflation than aliens kidnapping me. Just give me the stock prices wherever you take me. So speaking of inflation, this is from Kyle Bass, okay? We talked about last week the Chapwood Index and how the actual San Jose, Oakland 5-year average of inflation performance is 13%. I thought this tweet that he made was really interesting. The Fed's gauge of inflation is a joke on the U.S. population, okay? I'll read it again. The Fed's gauge of inflation is a joke on the U.S. population. The BLS shows that the average car prices are up 35% since 1980, 39 years ago. In 1982, the average car price in the U.S. was $7,000. In 2019 today, it's $37,000. The real inflation number is 500% plus or more on cars. I never knew cars were $7,000. That was mind-blowing for me.
Think about it. In 1980, the car had 4 wheels, engine, and brakes. And your luxury was having a radio and
cars have a lot more features nowadays than
But that's fascinating because again, as investors, we need to observe and pay attention to price changes because it basically affects everything, right?
I mean, if you compare that to housing, 40 years ago, probably a house would be 30,000. It's not that different from a car.
And I wonder what the average Joe interpret this as, because they don't know money printing, right? So how would they interpret it as? Like, oh, just homes go up, people, more population. That's one factor. But are we printing money quicker, or the population is printing quicker? Those are two factors that bring up real estate, right? You had a comment?
I'm surprised 37,000 this year in 2019.
That'd be more.
Average
Average
car,
cars.
There's a lot of expensive cars out there.
How much is a Cybertruck? You already?
Check is 39.
Okay. Yeah. So for me, comments on that, my mind is blown. $7,000 for a car. Yeah. This was an interesting chart that I saw, and it's. Can I fill the screen? Oh, I'm gonna have to zoom out a little bit. Oh, actually, no, it's okay.
It's okay.
Okay, global pension system funding demand versus supply. You see the delta? The delta is the difference right here.
Trillions of dollars.
Trillions of dollars, and we already. This is just starting in 2018 too. That's the crazy part.
Okay.
Yeah.
About the last 500% statistics.
Yeah.
It's a little bit like there's a bit of a negativity around his comment there that the Fed is not keeping track accurately.
I don't know if they're keeping track accurately. I think they are. They're just not for the masses purposes. Yeah, for media mainstream purposes, we want to give the things are okay.
Yeah.
Beware of dog when there's no dog.
Right.
Yeah.
But to say that it's overall bad that it went from 7,000 to 37,000 is it really you got to look at incomes. And if incomes have gone from maybe 20,000
Yeah.
to 100,000.
Yeah.
Then
It really comes down to the multiple, right?
Right.
So if you remember, I had a real estate chart up here on real estate prices in San Francisco. Back in 1980, the multiple of income to home prices was about 2 to 3x. Today is about 11x. Meaning, so back then in 1980, you made 20K, but the home was 60K. Today you make 100K, the home is 1.1 million.
if you look in the Bay Area.
If you live, Pishang, you went, oh man, you came back from all the way in the East Coast? Have a seat up here, man. Yeah. So Pishang is like one of the, so we've done 100 and something lectures now, and he's been since like, I don't know, number 20 something. So it's been 3 years with this gentleman. He moved over to New Jersey, right? Yeah. Hey, well, nice to see you back, man. Nice to see you coming back here, actually. So going back to this, global pension system, funding demand versus supply. What does this tell you? Like, how are you going to protect your kids moving forward, right? They don't really, the system can't keep going. It's going to collapse. But if we keep it going, how do we do it? How will this is a sovereign problem, right? It's how do we engineer the solution? Okay, retirement will be 66, 67, 68, 69, right? Forever. So that's one way to engineer the problem away. But yeah, this is a serious issue because I don't know. It's mind blowing to me because the rest of the world operates under the belief that it's the opposite, where there's massive surplus of pension for you when you're at the age.
To me, that's where if you're on a fixed income or you have debt, the government is trying to solve that by creating inflation.
Yeah.
So there are people who are at a disadvantage. But if you have debt, actually, like the government, then you're taking advantage of it along with them.
If you had debt that you could not care about.
Well, like if you buy a house and you owe a lot of money on it, you're actually that's gonna become peanuts over the course of decades.
So I spent a lot of time reading this week, and a very fascinating thing that I've learned is that Japan's a really great example of how like they inflated or they printed a lot of money in Japan, but it hasn't been reflected really in stock prices or real estate prices. It kind of capped out, and so I now know why. Does anyone want to speculate as to why Japan prices didn't go up as they printed money?
Less population?
No, the culture. The culture is different. The culture of saving. And so remember when I said when the sovereigns print, the excesses to the producers, they'll reflect it in stock prices. The excesses to consumers will reflect it in real estate. For the Japanese as a culture, it's reflected in each individual savings accounts. So if you analyze the aggregate of the consumers, they have a lot of savings. That's amazing.
The tax structure, I think even in Europe as well as in Japan, I think it's more taxes are on what you spend.
Yeah.
You save, you're not taxed.
Yeah.
That's the flip side there is that.
So I've learned something really nice because when I was reading it, it was saying, well, given Manhattan as the example and London as an example, if you look at the population, everyone has like 0 to no savings, right, or liabilities. But if you look at the Japanese, they have a ton of savings. And so the population of Japanese people are symbolic of like, it's really symbolic to me because it's like, wow, it's not just one person, but they know how to save, you know, for a rainy day. Maybe I should move there. Because that's opportunity, right? Because if you were like a insurance salesperson or a financial advisor, you'd be going out in Silicon Valley looking at everyone who has a 401k that hasn't rolled over to an IRA, so you could raise funds, right? And then over here, it's like everyone has savings, so what they need is investments. So yeah, I found that very fascinating. But this is truly fascinating as well because we're talking about the global pension system. If you were to aggregate every sovereign pension system, with the amount of supply and demand we don't have enough. So, and that's only going to be expanding. So my take is that they're going to engineer this by raising the age. But the other question is that as we as a population, do we engineer our age to grow longer? Because if not, then they're getting rigged. Right? Over time, you're getting rigged. If you don't live long. Like if I'll take the 67 retirement if I'm going to live to 200 now. Something like that. Right? But if I'm just going to live the same age or even less, then again, you're getting rigged, assuming you stay alive. But yeah, fascinating chart. What else? Another one, I think you guys would get a kick out of this one. So this is, someone did, Sentiment Trader, they did an analysis of Trump's tweets. So there's the blue, but ignore the blue, look at the green. If you notice that this is the S&P 500, right? Every time the S&P 500 really dipped, his level of tweeting went like, he just went silent on Twitter.
Oh, that's funny.
Right? Versus when it's like all-time highs, he had like the highest amount of tweets right here, like 29, 31 tweets.
But he tweeted before the price going up, right?
Before, so it'll be right here, you mean?
No, like you look at the peak.
The peak right here?
Yeah. Yeah. The peak happened before, right?
Yeah, you're right. So he got really optimistic, and then the market's tanked, and he just suddenly dropped off.
That's true.
Yeah. Right? So where are we at today? Use the example of today. Yeah. So he could tweet a little bit more. You know, that could be a cool indicator for where Q1 2020 is gonna be. I just thought that was fun and interesting. Is there an index for that officially? No, I think it's just some data scientist geeks who put it together out there. Here's another example of valuations out there, right? Our total debt to GDP. The last time we're at 100%, meaning our total debt that we owe is the same as our GDP. Last time we were there was in 1946. So we surpassed 2008, well 2001, right? So I'm not this has nothing to do with corporations. This is only a sovereign thing. So the last time the sovereign was in this type of situation, you see what I mean? You have to segment the markets. The corporations, it has nothing to do with the profile of Apple. Apple looks good.
Did S&P go up after 46?
After 1946?
Yeah.
So we wouldn't look at the S&P 500 because that's corporations. This has nothing to do with corporations, right? This is the sovereign's profile only. This is the government's financial profile. So last time they were this extended was 46, right? So
World War II, right?
So what I did was I stacked the value to dollar. The last time in 1946, this is a breakdown right here from a technical analysis, and it just fell off, right? So I'm thinking this is a bullish case for gold, because the only time that gold would make sense is more not corporate. It has nothing to do with corporate. Gold is more of a sovereign hedge. It's the only tool that works when the sovereigns doesn't make sense.
So are we predicting that it's gonna even dip down even further?
Yeah.
So if you do a log scale, then you'll probably be able to see that dip.
Yeah.
This chart kind of becomes worthless after a while because it's on a scale of
Hey, don't forget this is what we all work for.
Well, it's on
The
a
dollars.
scale of 1,000, but the changes are now in the single digits.
Yeah.
It looks like a scale. It will probably show.
So this is you're right. If we could see this segment right here, if I were to zoom in, we'll get a better view. Maybe I could do that.
Yeah.
Let's see. Do you guys want to know what this chart is, or what it means? If anyone doesn't know, this chart basically just shows the value of the dollar, right? It started off here, and they couldn't collect enough taxes, so they had to devalue the dollar. That's another way. That's called inflation. That's another way of robbing your purchasing power. Again, if you don't know purchasing power, you make 100K today. That means you could buy 100 iPhones, but next year you make 200K, and you could still only buy 100 iPhones. The iPhone prices went up, but you're in the same position as last year. And the solution to that is that you have to invest to protect yourself against that. So if I were to pull up the consumer price index real quick, and then consumer price index, urban dollar, and look at the Fred, and we'll look at the recent. Would that be 419? What time frame would you guys want to look at in that case? So what would it look like today, right? I don't know if this is helpful.
Let's do a 10-year.
10-year.
2012 to 18.
Here, 10-year.
So that's showing 2%, or what is that?
What were you looking at?
From 46 to 39.
46 to 39 in the last 10 years. Yeah. And if we look at the actual currency, right? Go over the futures. Look at the dollar index, and look at the futures. Yeah. So do you know why the dollar goes up? It could be several reasons, right? It could be global uncertainty. Everyone runs to the dollar. So there could have been uncertainty in 2008. There was uncertainty in 2008, so the dollar went up. There was also a lot of uncertainty in 2014, 2015, it seems, right? I remember the stock market going sideways. So what I'm looking at now is for this dollar to continue its decline to the downside. And that's pretty much it. Any questions? Okay, all right. Moving to the next interesting chart. So yeah, just keep in mind that this is the sovereign's profile. Nothing to do with corporations, but that nature, the stress nature of the sovereigns could rub into the corporate profile. Going down to the next one. This is an interesting chart. It's been going like everywhere on Twitter. But central bank gold buying set for a new high in 2019. This is good for gold. It's showing that the biggest sovereigns and their ghost entity, their illegal entity, or their legal entity, is purchasing record levels of gold that we haven't seen since I guess 2012 or 13.
Why did it drop in 2016?
Why did it drop in 2016? Because gold went down. Gold prices went down. So if you recall going over the metals over here, looking at gold, 2016 was the low, right? So did it pick up in 2016? No, 2017 the fear was still there, but 2018 it picked up dramatically, and then 2019.
More in 2016.
Say again?
They should have been buying more in 2016.
Yeah. I mean, that's blood in the streets for them, right? Because they're buying at a larger scale than any one of us. So knowing that it's hitting new records, there's new. Remember, all-time highs is typically bullish. This is all-time highs in terms of central bank purchases of gold. That to me really reinforces the position in gold. So I'm getting extremely bullish on gold once again for the next leg up here.
Do you know why gold miners went up a bit last week?
Yeah, it's interesting because gold miners went up first. I was observing. Miners went up first before the actual commodity price. What does that tell you? Well, there's gold. Gold is 1x leverage. Gold miners is 2x leverage, and then gold miners junior is like 3x leverage. Who typically plays leverage? Leverage funds called hedge funds. So I think it's just hedge funds positioning in early. That's what it appears to look like. And relative to the gold price, right? How gold could be influenced. Gold is more of a global game, so it would require global players to influence the charts versus miners that's like 100 million, 500 million. Any decently sized hedge fund could influence that. So that's my theory on why did gold miners perform early before gold prices? Because I think these hedge funds are starting to react. Yeah. And I don't know did that even make sense or?
Yeah.
Okay, all right. This is another interesting chart. The dividend on energy stocks beats the yield on U.S. Treasuries. Yeah, I found that really interesting. Aren't treasuries like the most protective assets? Right? Oh, we'll see. And then if you look at Warren Buffett, right, his portfolio real quick, I'm going to skip down. If that's true, that energy stocks are beating treasury yields, this is Warren Buffett's asset allocation. He has, if I go down, he has 34% in cash, 61% in equities, and 5% in fixed income. So he's not even playing bonds. Well, 5%. Maybe like short term. But yeah, he's not really playing bonds. He's mostly equities. And he's buying energy stocks. Because I think I see it now. I think the game has evolve to the next best opportunity, and the next best opportunity that looks like fixed income is energy stocks. So that's where I'm looking at now. So energy transfers, Oxy, our Occidental partners, enterprise product partners. Those are three that I'm looking at for deep value play, as well as dividends.
Fixed maturities of securities?
Bonds, fixed maturity, like fixed maturity of 10 months. I'm sorry, 10 years. So it's equities is stocks, fixed maturities is bonds, and then cash is just cash. So this is Warren Buffett's actual asset allocation, how he's protecting himself. He's more in cash than bonds, right? So it's just another way to kind of give you an example of how to analyze a portfolio. In terms of so Buffett also has a Buffett indicator. I don't know if you guys know. I look at it from time to time, but the equation is basically the total market cap of the entire stock market divided by USA GDP. So if you go down, the ratio of total market cap to US GDP, the last time we were here was not 2008. So based off of his personal Buffett valuation indicator, this is what it says. According to Warren Buffett, the markets are significantly overvalued. 152%. But, you know, the regime is different. There's money printing. So we have to, this model might be broken, right? Just like how if you lower interest rates from 0 to -1, then all the Black-Scholes model will be broken. It wouldn't work with -1. So it's definitely a different regime, but nice to know that what he sees as how he values the entire markets. Again, this is a great global macro tool if you were to analyze that. Skipping ahead, the different sectors out there, number of stocks, but the Shiller PE ratio. So again, where's the cheapest sector that you guys see? Energy. Energy's at 16, 17.
What's a Shiller PE?
Shiller's it's like another optimized PE ratio. That's by, I forgot his first name, Robert Shiller. Yeah. So you could use his, right, where he kind of optimized it a little bit, but you could average them. You can use 2 by averaging it out. But looking at it, yeah, I mean, I thought technology would be higher than 33. Apparently, well, that is these two are high. So real estate's at 52, communication services. This is pretty defensive, I'd say. Very defensive. And then this is growth. This is also could be growth. This is very defensive as well. Consumer cyclical, I'm also bullish on. Industrials, defensive, consumer defensive. Oh, that's staples. And consumer okay, I thought they were saying. All right.
It seems odd that something which is defensive would be at a PE of 30 and technology only be 33, right? I mean that.
Now you're looking at defensive 37. You go down to technology, it's 23. You gotta look in one row. No, you can't cross over to Shiller and then use the regular PE ratio.
No, I'm just looking at the Shiller PE. Right?
Oh, okay.
So technology
you're right.
is 33, and then utilities is 32. So that seems kind of like utilities.
Oh, utilities 32. Yeah.
And technology is 33.
Yeah.
That seems rather strange.
Yeah, that is strange.
Real estate is 52. I mean.
It's a mixture of like.
Is it a stock real estate? When I say real estate is 52.
This is just a whole sector, no individual stock, but this is telling me that if utilities high like that,
maybe overvalued.
Then it's getting people are piling into utilities for defense. So there's fear. That means in a maybe it could mean there's
maybe
fear.
it is overbought and it might go down.
Yeah.
Well, the demand for utilities increasing.
Yeah. Now keep in mind there's the number of stocks also matters too. There's significantly more in technology than there are in utilities, right? That number could mean something as well, because if the business and utilities was hot, then there'd be more stocks. So it's how you read between the numbers. Again, just a bigger picture look, nothing to go crazy about. But this is the XLE ETF. If you look at the bigger picture perspective, yeah, it looks like there could be a bottom. But I'm not looking at XLE, it's too broad. I want something more specific. So I'm just handpicking the stocks I like. So broader market update. Man, we talked a lot today. Or I felt like I talked a lot in the last 20 minutes. You guys doing okay? You guys want some water or bathroom break? Yeah, let me know. Bathroom's on the left, water's in the back. Feel free, just be comfortable, relax, and ask me any questions you have. Broader market update. So the year-to-date scorecard. I don't know if you guys look at it, but it's, I won't see you guys until next year.
Yeah.
So I figured I'd put up the scorecard.
Next decade,
I won't see you until next decade, so like Bernard said. But check out the scorecard of the last year to date, okay? So S&P 500, 30%. That's where I feel like, okay, moving into Q1, we got to get defensive because it's just like, are we expecting another 30% in 2020 in the next decade? Maybe the next decade, but not in the next year or the next decade. So I think market's a little overstretched. Looking at other segments, IWM, so small, or IWV, Russell 3000, 30%, Europe, 26%, all world index, 25%, small caps, 25%, developed markets, 21%, gold's been performing 17% this year, emerging markets, which I'm attracted to, 16%, silver I'm also attracted to, 14%, cash, 3%, dollar expected to go down, 2.51%, so dollar kind of went sideways, which is good.
So everything is up this year, pretty much, right?
So is there also a measure of inflation? You take a look at dollar.
That's the measure of inflation?
Everything is up, man.
Yeah, I'm with agreement. Feds can't stop printing or defaulting. So, now that I'm thinking about when they say in the news like, oh, the Feds are printing money. Oh, they're defaulting.
It's a new norm, huh?
Yeah, I think that's the new norm. So it's going to affect how we as consumers down to our level will behave. It seems like every week now the Fed is abruptly adding more money into the markets. The question is, at this velocity, observe the slope of the retracement. Sorry, that makes sense just now, but my point is just observe the slope of this because it's indication of fear. Because it's very easy to not appreciate, like you're just seeing it on a screen, right? But keep in mind, this is a lot of money that just moved. It's hard to appreciate that when you don't understand the economics behind it. But when you do, you really appreciate it because it's really interesting. At the same time, the dollar's falling, and I showed you guys this earlier. So I think we have a confirmed downtrend right here, and that really sharp move is indicative of like further downside to me. Looking at the ETF, right? Because this is the dollar futures index, and then this is the ETF that is a proxy that represents that as well. It's really breaking down the 200-day moving average.
Yeah, but don't forget that. Look at the axis though. You're talking like from 94 to 100, not 0 to 100. So it's a bit deceiving, even though it's down.
Yeah.
It's down from
the sensitivity of this is higher.
Yeah.
Yeah. So so ETFs are proxies, meaning it's just supposed to represent the real thing. This is the real thing right here.
What I'm saying though, I mean, it's really down like single 2% in 3 months. It's not down 50%. Like that kind of looks like it's caving in, but it's really not.
Yeah,
right?
yeah.
Look at the scale, 94.5 to 99.100. If you change that scale to 0 to 100, it would look completely different.
Yeah. So the ultimate way to look at all this is probably through FX pair, but I know you guys were probably not used to that. So looking at something like this, right? Euro dollar. This should go up because the dollar's going down. Meaning, if this is going up, then the euro is appreciating, and if it's going down, then the dollar is depreciating.
It would be kind of interesting, Kay, if, I don't know if FinViz or Guru folks.
Oh, I'm sorry. If it goes down, the dollar's appreciating. Sorry about that. Yeah, I had to correct myself.
It would be interesting to have these scales like from 0 to whatever the value is. Because this kind of makes it adds emphasis, I think, in what the move is, but then it sort of distorts.
So
that's right.
It's very
With
hard.
that could be more meaningful.
The graphs are designed to be, the more dispersion you add, the clearer it is to see the theory, what you're trying to explain, right?
Yeah.
If I put it on 0 to 100, you would not be able to see it at all.
Yeah.
It would not be visual indicator.
Yeah.
But it would be
It's
accurate.
I know this is not going to be easy, but I think if you use Bitcoin as an example, right? You have to compare Bitcoin against a major currency. You could do Bitcoin against euros or whatever, but this is the Bitcoin against the dollar. It's just a mathematical tool for us to kind of gauge relative pricing. All right. If you look at it long enough, you'll pick it up over time. So based off of the market conditions, right? I know that the markets are up 30% for the year. How am I kind of forecasting this? So markets are up 30%. I'm becoming more contrarian here and looking to get defensive as well as participate on the other side of the trade. Observe the last time we had a 30% performance in the market was 2013. I showed you this earlier. So the next year in 2014 was a 10% performance. So the question is, with a 30% performance in 2019 followed by another 30% performance in 2020. So that's my thesis. That's my crystal ball right there. I don't think another 30% would make sense. If it does, then we're really expanding inequality here from the the have-nots to the have. There will be social uprise, right? It's good for stock market participants, but keep in mind, we know that the only people who play the stock markets are corporations.
SPY forecast for 2020 is 332.
332?
Yeah, it's strong on global.
3.32, right?
Oh,
332. Yeah, gotcha.
So
yeah.
when you're already at 320, so you have to go down before you go back up.
Yeah.
So okay, it would be more meaningful though if you looked at the 24-month period to the next 24 months, because it's not fair to compare December 30, 2019 to December 2018, because it dropped a lot at the end of last year. So it's not really a fair, relevant, it's not a fair comparison.
Sure.
Right? Just look at the shape, right? Just look at the 2-year graph. Like, see how it's sort of like, you're comparing it to that dip at the bottom,
so
not when it was 3 months before.
We will start with 2018, right? And to the high.
That's right. So
would you do the 2018 high, or would you do the mid?
Just like ignore all the little dip. Just write that off. Right?
Yeah. So if I were to write it off, we're up about 13%.
Right. So the question, well, a fair question would be, will 2020 be closer to another 10+% return? Would be a more reasonable, or is the market going to cave in? I actually think that all the signs suggest it's going to be going.
So my logic right now is that I think money printing will continue. There's a lot of fear, and that'll add as tailwind to the markets. But the markets are also up 30%. So my expectation for Q1 to Q2 is volatility. And then after half of the year, after 6 months, the second half, it's going to rally. And we're probably going to get like 7 to 10%. I know that sounds crazy, but that's the power of money printing. And I also think the money printing will go to new record highs. So if it goes to new record highs and prices go up, well, I think that's going to kick back into real estate prices, right? Our cost of living is going to go up. That cup of coffee I'm always joking about, how much you pay for that? Like $5? It's probably going to be $6, $7. Right? Yeah, it's going to get tight. But that's my expectation. I think markets will dip for the first half, and then it'll recover, and will probably remain constant or higher. I think because it's a major breakout here. This is a technician's analysis, but also it's a breakout assisted with money printing. So I know it sounds crazy, but I think markets are going higher. With that, but first with a break. It needs to take a break. 30% is a lot. Moving on to the next part. So comments on specifics, right? Broader market analysis. S&P 500. Nothing much to say. It's just really pushing up higher and higher. And then this one is the S&P 500 earnings.
Okay. Would you take the dips, the 3 of them right there? Would you get like the average of that correction? And so the next correction that happens, you get the average of those 3. Would that be a time to buy in?
So I think there's going to be some volatility, and I think we could probably go as low as maybe 310.
Like say there's like a 20% correction.
So yeah, if it's a major pullback, I think we'll revisit 310 and then go higher. But if it's like a minor, I think we'll experience a minor first. The minor will be down to 320 to like 319, 318.
So just look at what happened in August. Okay, first of all, it didn't happen in a day. Right?
Yeah.
So if you look at that from 300 to 280, that's less than a 10% drop, right? So the question is, do you start to say, put the money in the mattress or the CD fund on December 31 and the market's going to go down 10%? If you did that, you could say the same thing in November, that it went from 300 to 320 and you missed out on another 10% gain.
Yeah.
So the question is, how risk averse do you want to be
Yeah.
to miss out on another 5 to 10% versus what happened in August and October of about a 7 to 10% drop. So is that 7 to 10% potential drop enough for people to say, I'm cashing out, I'm going to wait for this 7 to 10% drop, or am I just going to leave it in and get a hope for the best of another 5% return hits in January through March? Yeah. And that's what you're really betting on.
Yeah. So I'm aware of that, and I think the strategy is we can't predict the S&P 500. That's the hardest thing for me to predict. And I think that's the most challenging instrument out there. That's just basically the direction. But I think the moving forward, the way I'll continue to push my efforts is I'll continue to buy strategic assets, like PagerDuty at such a relative value steal.
Right.
And I'll continue to pile into high dividend value stocks that no one else wants to play because I see a bottom, right?
So one more thing. So
and also gold miners as well because the money printing. That's more of the sovereign trade, the global macro trade.
So what people are going to be trying to listen for is the guidance from companies in their earnings calls in February.
Yep.
So the question will be.
We have that guidance. We have that aggregate guidance right here.
Right. So if October through December, if everyone thinks that the Christmas season was spectacular, which it probably was, it's not what you did in October through December that matters. It's what you say you're going to do in March through June, April through June.
Yep.
So that's the wild card of, even if companies say they had their best December in history, are they going to have forward positive guidance saying that it's going to keep going?
Yeah.
And if you want to gamble on that, well, Apple say they sold more iPhones in their history in the December rush, but they're a bit cautious about what's going to happen, and then the stock will go down 5%, right? So it's that's what people are going to be listening for, is that trend of guidance in the February.
And I'm also stacking. So the corporate guidance is one thing, but I'm also stacking the financial profile of the sovereigns and the incentive to print more money.
Yeah.
Because that will just inflate blue chips. Blue chips are like real estate. Because there's no other Apple, there's no other Microsoft. So they just get inflated through money printing. So again, the stress in my analysis of all the pipelines is at the sovereign level, and then the corporate buybacks. So they are leveraged. If we look at the S&P 500 earnings, right, the last trailing 12 months, the last few quarters, it's just been kind of sideways. And so you've been hearing like, oh, we're in an earnings recession. The dark color is the actual, right, and then the orange is the current one. So this is where we are currently for earnings. So earnings have, for the most part, been sideways. And then the forecast is always the salmon color. Or the salmon color is the initial projection. They always forecast it higher. I mean, you look at it over here, it's the forecast. It got better, right? But we want that salmon color to be as minimal as possible.
Yeah.
So that's the analysis for S&P 500. If you were to aggregate the top 500 best companies, and are they earning more? Because if we're printing more money and we're inflating the value of the corporation, well, these high quality names like Apple, are they selling more phones because there's more people with money out there?
Right.
So now that I think about that, earnings reflection would be really good indication that consumers are buying. Because if we printed money and earnings didn't go up, that means all the money went to the rich people that are not buying more iPhones. Think about that.
Yeah.
That's fascinating. Damn, I learned something new just now. Huh?
Just like Japan, where it all goes to savings.
Yeah, yeah. So if they continue to print, because they have to, I think we might even get to that scenario where everyone's just saving like hundreds and hundreds of $1,000s in their savings accounts from 350 million population, waiting for the next best investment. So if I know that, if everyone's saving, it's time to become a venture capitalist, raise some funds or something. It's opportunity, but you just gotta see it. My mouse is not working. Okay, let me move around. Okay, here we go. So I'll go quick on this part because I want to review some stocks. So NASDAQ also going up. Again, Dow Jones also going up. Nothing much to comment. Russell 2000 kind of pointing up. A little bit of weakness, but yeah, markets are just going higher across the world. Now we look at USA. We want to do a total analysis, right? Looking at Nikkei is just going up as well. Money printing flooding the entire world, it seems like, or every central banker just devaluing the currency. Looking over at the other major area, Euro Stocks 50, the European area, and then the DAX, they're all kind of pointing up. So nothing much to comment there. Meanwhile, bonds are pointing down, kind of expected because there's not really fear. Looking at the yield curve, I know we analyzed in the past, just it was inverted a little bit, but now it's kind of back to normal. So
is that whole inversion thing a non-issue now, like completely off the table?
I don't think it's completely off the table. I think it's just been manipulated away.
Huh. Okay.
Right. It was actual indication of stress in the system, but manipulated away by the Feds.
Huh.
Right? Because the Feds control the short-term yields. So the short-term, these are all contracts, right? Like 1 month, 3 month, 1 year, 2 year, 5 year, whatever. If it was up like this, they control it down. So I think they've successfully controlled it down.
Interesting.
Yeah. And then now the question is like,
money, right?
They what?
By printing more money.
Yeah, by printing more money. Make the dollar cheaper. Cheaper dollar means less attractive. Okay, so, man, I gotta remember all this stuff. If rates go up, the dollar looks more attractive, the dollar goes up, but they want the dollar to go down, so rates go down. You gotta practice that part. So what does that mean though? If the dollar's going down, I think it's time to buy emerging markets.
Yes.
we have to really consider emerging markets. So I've been analyzing Chinese securities, but I think I forgot to put them in here, so I don't have the Chinese stocks that I'm looking at. But stocks like Alibaba, Baidu, even Baidu. Baidu's a blue chip in China. It's beaten down. It's starting to look attractive because, again, EEM is going up. If you're a lazy investor and you just want allocation to that moving sector, then yeah, just buy EEM. Educational opinion only. But if you zoom out EEM, looking at the monthly, channel down, break of the channel, support at 40. So risk reward wise, it looks pretty good. And we know guys like Ray Dalio or whoever, they have substantial, like 30% of their portfolio exposed to emerging markets. So now you have the confidence of a real money manager, not just Kay telling you, hey, this looks like an opportunity. Other things to look at is I'm also looking at DBC. Again, it's a proxy to measure. It's an ETF that measures commodities.
What kind of commodities?
Just aggregate all the commodities.
Oh, okay.
It combines oil as well as like coffee beans to livestock to even gold. So it's a very packaged product, but I just use it to kind of gauge segments, right? Because my theory is that if the dollar goes down, it's good for commodities. So I want to see if commodities are responding. As of recent, it did, because it did gap down, but it is responding a little bit. Again, this is more me leveraging existing market instruments to kind of gauge tools of global macro, right? Because once I understand global macro, I can zoom it down to, okay, is it a good environment to buy PagerDuty? There's a lot of work just to identify should I buy this security or not. Anyways, yeah, that's DBC. If you zoom out DBC, again, I like to get a bigger picture. It's pretty beaten down. It looks like the oil chart. It really is the oil chart because it's a pretty significantly traded around the world. So yeah, DBC is precious metal? No, DBC is a ETF. Yeah, it's just commodities. Yeah, I leverage that for commodities. Just like UUP represents the dollar. When you watch the stock market long enough, you kind of get lazy to look at the actual indices, and so you just create a watch list of ETFs, and then you're like, okay, I could probably trade these ETFs too. That's the beauty of ETFs. You could actually trade an index. So looking at gold, so what does this mean? So now that we saw what the commodity segment looks like, let's look at gold. I think we have a breakout right here. Yeah. And gold is getting really exciting. And the miners have started moving first. And I wouldn't say my joke this week, but some of my investor friends, like other investor friends, they're texting me like, dude, gold's up. And I was like, yeah, Santa came early this week. So yeah, I'm excited for this because if this is the next leg, very powerful leg over here, as you noticed, right? The last time we had a breakout like that, on pretty good volume, or not so much volume, but very good move. I think just the time has to keep moving forward, and as time moves forward, the economics are always moving. And so I wake up every day with a big smile because I'm always thinking like, there's so much economic opportunity out there, but I understand every economic opportunity is a closing window. So it's a matter of how you capitalize. So I get really, I would even argue that I wake up to play a game that no one is really playing, but they are playing. You know, I'm playing because I'm aware of how the economics work, but most people aren't playing because it's just like, it's a matter of just like, 9 to 5 and life. Right.
Okay, is gold equal to GLD in terms of the shape?
So GLD is ETF. The shape-wise, yes.
So gold and GLD.
No. So gold. So what I have right here is the gold futures contract. So it's more accurate to what gold looks like because it's traded 24/7, right?
Okay.
But GLD is traded like 6 a.m. to 1 p.m., 6:30 a.m. to 1 p.m. Monday through Fridays. That's an ETF. So that one actually has money managers and robots behind the ETF to manage it day to day to follow this.
To follow that.
Yeah,
right.
because the issue, the business model of that is basically you don't know how to buy futures, but you know how to buy stocks.
Right.
So what if we engineer the future instrument and make it a stock and put it in the stock market, so now you could just access the stock market.
Yeah.
Right? Instead of like, oh, how do I buy futures? Like, oh, contract expiration. So because if we could get you to transact, like Charles Schwab get you to transact, then we get some fees from you. But those fees are kind of disappearing, so now they want your data, right? Right. When money, so this is where I also believe from a technological perspective that if money's becoming nothing and technology is becoming something, and every major corporation, leading corporation in the world like Apple, or maybe not Apple as much, but Amazon, Google, Facebook are chasing data, to me I think the next currency is probably data.
It is data already.
It is already for Silicon Valley. But for the rest of the world, they're like, oh, you have my personal information, or not personal information, but Why do you need to know where I am at a given time? Oh, I'm near that store, and you pull that data, right, for marketing purposes.
So if you were to take a look at all the different gold stocks, how do you compare which one is better?
You could do relative valuation, real valuation, so under below book value, something like an AGI or EGO. They're below book value, so I would figure they might get acquired. There will be a consolidation, right? Because Gold Corp, the one that we were looking at a year ago in November, it got bought out, man. I was like, oh my god, like I had a lot of calls on that, but.
Well, you predicted carbon black too.
Yeah, that was cool. That was really good. Well, Pivotal, they got acquired as well. But there's many more to come. Okay, now to speak of another Beyond short, right? I can show you another short that I saw. So Beyond was another security, Beyond Meat, that we called this short. Yeah. I see another one in a different segment. It's Lunkin Coffee. Luckin Coffee. Okay, all right. It's a Chinese company. I understand that emerging markets are bullish, but I think relative restaurant valuations are pretty high. Now, this one I think so, but the part that I don't quite fully understand, from a relative valuation, it is overvalued, and it's not a technology company. Unless it's a technology company, it makes sense. The only part that I don't understand is how big is China's population that can consume coffee. That's where I might be wrong on this trade. From a valuation perspective, to me, it looks like a short, but from a technical perspective, it's going up.
So they're competing with Starbucks, right?
They are competing with Starbucks.
They're trying to undercut the prices. I heard the prices.
And they probably could do it better because they're local.
I mean, they're not profitable when they're growing fast.
Yeah. So from a fundamental investor, I wouldn't touch this. But from a trader, I touch this on the long side, believe it or not.
Their
earnings seems that they have improved and they exceeded expectations.
Yeah, but it's not enough data, you know. It's just like 2 years. You're probably looking at a quarter, right? Quarter over quarter, but it's too risky for me. I think if anything, it'll go down before it'll go up because it's trading. The price of this is trading like a software stock, and it's not a software stock. Look at the gross margins. So that's where I feel like, yeah, this one is.
Damn, why didn't you cover that a month ago, man?
On the long side, I wouldn't even recommend that. That's too dangerous. Aaron said, look at a short float on Lunkin. See, a lot of people are shorting it. Oh, so this could be a short squeeze as well, right? Too many players are shorting the stock, and so people are buying it up, and it's like, oh, we gotta unload, we gotta cover our positions, and we buy it back.
That was your bias.
Tesla again.
Yeah, it's like a Tesla scenario, right? But I mean, why were they short in the beginning? Because it was overvalued. So going back to the gold, right? So now that we know the gold prices, it's starting to look really attractive here. Going down to silver, same thing. So I don't know if I'm more positioned in silver, but I have significant position in silver calls. So I added more all right here, so I'm pretty happy. I think it'll probably just consolidate and we'll probably get a next leg. But I really like silver. Platinum, I mean, both platinum and silver look attractive to me. Again, why are we buying platinum and silver? It's really a hedge against a sovereign who are at the point of defaulting, but they don't default. They're at the point of printing. Right. So when they print, it really, you know, I thought about it. You remember how I said there's pre-doomsday scenario where the dollar collapsed? I realized like their form of resetting the game is this right here, where they have to print money, and printing money is a form of resetting the game because the game's gone too tight. So this is the gold prices, right? So you got that nice rounded bottom and then setting up right here. This is looking really bullish for gold on the monthly chart. But if you look at silver, man, silver is cheap. I'm not trying to express emotion to get you excited to, lose or make money, Joe.
Excited though.
I'm not trying to be a Kramer like you said and smash a button or whatever. But look at platinum and silver compared to gold, right? So gold's the leader, obviously, and if gold goes up, then these will follow through as well. Palladium's already kind of just, man, that one's a tough one.
Has the demand for palladium changed?
I mean, demand? I mean, it's
used all over in chips and whatever, right? But is it still, I mean, that's pretty spectacular growth in a year, right?
Yeah, so I haven't done deep analysis of palladium, though I know there's, jewelry from palladium.
People breaking into Priuses to rob palladium out of it, I know.
Oh man, I gotta be careful then. I didn't know that.
It has a palladium component in it.
Okay. Well then, yeah, that means our Priuses are appreciating in value. I kid you not, I bought my Prius used because I'm not the new type of car purchaser, I think the price probably sustained itself.
Yeah.
And stacking inflation, let oil prices go up, palladium prices go up. Man, this is becoming an asset. Huh? Oh yeah, it's interesting to me. But anyways, so yeah, platinum, silver, they look attractive to me once more. It's up to you to make the call, but be patient, in my opinion, educational opinion only, because I think the next leg is soon to be. Now we're gonna go to Bitcoin, and I know people are like, ooh, Bitcoin, all that, or Bitcoin. I'm personally bullish on Bitcoin, again, for several layers of reasons. Demographically bullish, because the next generation that comes up, like millennials, need some sort of upside asset class. And because they're so digitally native to the mobile devices, where they're mobile first, really gives me that bullish feeling. That's the demographics. But mathematically is very bullish as well, because, again, it's a simple equation between how many Bitcoin to how many US dollars, right? If we're going to print dollars, Bitcoin's not going to $1 million. It's the dollar that's going to negative $1 million or whatever. So that's going to naturally cause Bitcoin to go higher. I do see some basing, from a technical analysis perspective, there is some tightening right here. So I'm getting interested again. I do have Bitcoin already. I don't know if I want to buy more. Maybe I could buy a few more. I don't know. But it's the mathematical asymmetry is so attractive that. But I don't want to go more than a certain percentage of portfolio. But then I know this is really possibly a once in a long time opportunity because of the global macro situation. It's sovereign distress bullish, meaning the sovereigns are out of control printing money. And it's just a product that's sitting there at a very interesting time in our history. So, less than 1% portfolio allocation of your net worth in Bitcoin, I think can go asymmetrically, mathematically, very far. 17 million units to protect a global population of 7 billion or whatever, right? Who are trying to protect their money. And I don't know. That's my take on it. There's several layers of bullish thesis cases for it. Zooming out, doing a quick Fibonacci retracement is pulling back to the 23% right here. I'm sorry, 38.2. So potential support that I'm kind of looking at, but I'm just patient with this one, right? Because I'm looking bigger term and the possibility of how technology has changed us, right? Today we are digitally native to a mobile device, and we're seeing new business models like the influencers on the internet and all that, which I wish I caught on earlier. You could become wealthy for the dumbest things ever now, right? You could put your face on bread on Instagram, and you get a lot of followers, and that's good. That's good marketing. Or you could just eat food. So I see that a lot now. It's just when I go out to brick and mortar, I like Fry's, right? Fry's to me is I gotta appreciate this stuff because this is a museum. It's gonna go away one of these days. So when I go in there, right, I go into Fry's and I run to the far corner of Fry's, right, and it's I'm looking at the other corner. It's wow, it's a whole football field of just stuff from things that you can buy on the internet. So I try to appreciate those things because there used to be was it Barnes and Noble, not Borders, right? Barnes and Noble or Borders, I forget. No, it was Borders at Santana Row. That was really nice. It was 2 floors, and I used to like going there, but I was too young to really enjoy it. But now it's gone. So I wish Amazon came back with a 2-floor bookstore because I'm into the whole bookstore stuff. Libraries are. It's a public spot versus a bookstore is private and for profit. They take care of it, right? I mean, I'm not saying the publics don't, but the type of people come in, it's from a wide range.
Libraries also have books from the 50s and stuff.
Yeah. So if they could do, I would be in favor of a really big Amazon bookstore. I'd geek out to that. The other cryptocurrencies, Litecoin. So again, it's just Bitcoin's a leader. This one I'm looking at as well. I do have positions in this. Again, I wouldn't recommend more than 1% portfolio allocation. But if you're crazy enough and you believe in the asymmetry of the possibility of mathematics, demographics, sovereign bearishness, money printing, purchasing power, technologically bullish, you believe in all that, then that's up to you to go more than 1% of portfolio. Other opportunities that I'm seeing that's kind of arising is obviously the markets are pretty high, 30% up. So looking at the VIX, right? I won't go over the VIX futures curve, but these are instruments that I'm looking at. UVXY and TVIX are instruments that I'll be looking at to play short side on the markets through going long. So this is the inverse of the markets. I put up here, it's for more advanced traders and investors. I'm not going to go deep into it because of time, but just want to share that that's where I'm starting to see opportunity for some quick trades to make some decent money. Other else than that, we talked about the energy stocks over here, Oxy. Right. Yeah, so Oxy, I also have Warren Buffett right here. This is Warren Buffett's he's making moves right here. So he recently acquired some Oxy, but he didn't buy much of weighting. It's only 0.15% portfolio. But he did take a position, 7 million shares. Would that be 300 million? Yeah, 300 million. Huh. Holy crap. Only 300 million. That's going to pay him 30 million. Huh? Yeah, he has 120 billion in cash that he needs to put to use. So this was like in his terms, in his size, a piker amount. Yeah. You know, he didn't put 1%. If you put 1%, then it's like, ooh, conviction right here. Because maybe he feels like it's not bottoming, but it is a new position for him, so that looks interesting. Keep in mind, securities like Oxy, right, from a technical analysis perspective, is still in a downtrend, so you gotta be very careful. But it is tightening, meaning that downtrend is getting smaller and smaller, and you got some players kind of fighting each other like, no, we think this stock could go higher. Hey, it's at 6.7% dividend, I don't mind 8-9%. That's not bad. But just be aware that it's still in downtrend, you need to be positioning in very strategically. But these are some of my personal watches to kind of just put in the bulk of the portfolio into something, to earn something, right? It's different from a trading account. Trading account, you can go wild, whatever you want. So again, 7.87% dividend. Price to book is very close to price to book, but I think Warren thinks it could go lower. And in some cases, if we get undervalued securities, I think he'd be really happy. If the price to book for a $35 billion company goes below that, that means, let's say price to book is 1 right now, and it's worth 35 billion, that means they got 35 billion. So if it goes down to, let's say, 30 billion or 25 billion, and they have 35 billion in books, that's a sweet opportunity, right? Because you have some appreciation as well as almost guaranteed dividends. The other one is energy transfers, which we talked about as well. PE ratio of 10.59, price to book, not as low, but 9.39%. Sometimes when I'm looking at stocks, I believe that dividends could act as a technical support, right? Even though the charts don't show a clean support, but the dividend is just so attractive that I know these big institution guys who have a different problem than I do. Their problem is like, well, we have billions of dollars and we need to put it somewhere. Completely separate problem from what I have, which is like, I got some extra money, I don't mind 10% dividends. They have a more serious problem because they have to perform for their clients. So sometimes a dividend could act as a support, especially if it's a high dividend of 9% on a blue chip. 35 billion is blue chip.
So in the stock price, is the dividend included or it's not?
Say again?
So in the stock pricing, is the dividend included, reinvested, or it's not?
I don't think I understand the question.
No, it's not. The stock price doesn't account for the dividend payouts. He's asking if the stock price is adjusted for dividend payouts.
It's not.
Not.
I'm gonna skip ahead if that's okay. I didn't.
What he's trying to say is,
there was
the
no
stock reflective of the dividend payout, but it isn't. The
Gotcha.
stock is, the
Right.
price is what it is. It
Yeah,
doesn't-
yeah.
So,
I mean, the dividend will fluctuate with the stock price.
Right. It's like on some charts, they'll like add $1 to the stock price when they pay out $1 in dividends.
Oh, I see what you mean.
So then you can compare.
Oh, okay,
the
yeah.
stock price
So it's not,
over time.
yeah. So sorry. So for a second there wasn't any meeting of the minds. That's a legal term, by the way. EPD. So if there was no meeting of the minds and he wanted to sue me, knock on wood, give me an example. You can't sue me, man. I didn't get what you were saying. EPD. So this is the other one that I'm looking at, right?
What is that?
Enterprise product partners, something like that. It's another high dividend stock. This one's paying 6.28. Price to book is kind of high though. But from the technicals perspective, I'm seeing sharp bottoming. So I'm seeing interest here and some reversal action. You know, again, it's what you make of it, but to me it looks attractive already. It's not bad for some allocation because I'm bullish on this segment, and it gets increasingly more bullish as
What do they do? What is it?
Oil and gas.
Oil. Okay.
We're still in oil and gas.
Okay.
So I do have some Chinese stocks. No, I don't think so. I just have the large. Yeah, I didn't put the Chinese stocks in here. So given the dollar situation, it's going to change up a lot of economics around the world. FXI looks attractive to me. Again, this is a proxy ETF that tracks China large cap, so China blue chips, right? So if they're going to print money, China's going to print money, and emerging markets going to be bullish for the next several years. This is a very powerful proxy ETF to play, where it's a pure play of like you buy this, you own a basket of the highest quality names in China.
Okay, for Chinese stock that are listed on the New York Stock Exchange, is there a conflict of interest there where the Chinese government, a lot of these companies, you know, even like NEO, is sort of vested into by the government and has special, maybe special funding. Yeah, special funding, special opportunities because of their relationship to the government.
I know, man.
Would the government basically just abandon these companies now that the people who are profiting, the owners, are actually
No, because China's sovereign is particularly long term, and the amount of like NEO is nothing to them, right? What's the valuation of NEO? Like 4 billion?
Yeah, it's not even 2, I think.
Yeah. So to the, I mean, remember, you're talking about sovereign people, right?
So, but are they just going to abandon this and say, good luck, everyone in the New York Stock Exchange, thanks for your...
and electric cars are in China, I think that's where they should see the...
Yeah. So NEO looks attractive, but it's vastly overvalued. And I think it could go lower. I think it could go to even 1. I mean, there is some battle of reversal right here. So potential upside, but it's going to go sideways for a very long time. Very, very long time, in my opinion.
But are you worried about the conflict of interest?
That the government's going to have a tailwind on NEO?
Not
or?
NEO specifically, but just that, why would the Chinese government, who is very influential for Chinese companies, care about the success of companies that are owned by shareholders on the New York Stock Exchange?
Well, they won't abandon any of it. So look at Huawei, man. Go back 20 years. They've been basically, it's operating at 15% margin. I mean, full contribution margin. And they've been basically losing money, and they've been funding them for the last 20 years. But now they're competing on the 5G market. They can't abandon them, because then it sets a bad precedent. That means that to raise future, for any future company to go raise money, they won't have the New York, the American market to go raise money. Look at Alibaba and other companies, right?
So that reputation is...
It's mainly a place to float the stock and raise money, raise funds.
American money versus Chinese money. But I was confused as to where you were feeling the conflict of interest.
Just that if a company does poorly on the New York Stock Exchange,
right,
it's a Chinese company,
right?
You know, would the Chinese government say, you know, those are American investors, they spent $10 billion in this company, let it sink. We already got
No, because I mean the operations is domestic to China, right? If the stock doesn't perform well, they domestically get hurt from that business going out of business. They can't charge taxes and all that. They want that business to succeed, right? But they also want the financing to come from the USA. So there's several layers of interest from the analysis, but I don't think there's a conflict of interest.
So on the topic of the level of internal control in those companies.
Yeah.
So Microsoft will differ from Alibaba.
Yeah. So now you're talking about sovereign control. Now that's different. I think they're biased towards actually buying these blue chips. I think they have interest. They have a lot of interest in it, and it's really a lot of behind the scenes stuff that we don't know about to really explain it. You weren't here for the session, but we were watching. I was showing them a video of this guy who is exiled from China. If he goes back to assassinate him, I forgot his name, but it was in like a airport hangar or whatever, and it was Kyle Bass interviewing him. And he was just basically saying that, all the top executives are accumulating power, that, corporate power, right? So to kind of take a step back from that, you have to understand what does corporate power mean. Think of, so I was in where was I? Was I in LA? Well, doesn't matter where I was. I was in San Diego or San Francisco or whatever. I was talking to a friend, and this person was from Chicago. And I'm like, hey, you know, what's Chicago like? And he was telling me that how his brother runs a recycling business, and every now and then the mafia would come to the recycling business and ask for some money, right? And I was like, oh, that's interesting. So who would be the mafia of Apple, right? And then because I understand that there's tiers to everything, the government is the mafia of Apple, of corporations, right? So going back, taking that story, that concept of how, you know, SMB, small businesses, have the mafia in Chicago, whatever, that operates regularly and to collect money. That same thing applies to, well, the mafia can't go knock on corporations like, hey, Apple, we're the mafia. Right, they're too puny. They're too puny. They can only do SMBs, right? So take that same example and apply it to corporate level, then that's what you have, right?
Yeah, I heard an old one-liner years ago that the government is the largest mafia in the world.
Yeah, it really is. But I don't want to say stuff like that. So going over to the China example, right? So the interview, and this guy was, he's exiled from China. If he goes back, he gets assassinated. And he was just saying that they're forcing all the top players that are accumulating strength in the corporate game, that's becoming like sovereign power level, like Alibaba. They're forcing them out and taking their shares because it's like the whole, I'm not Chinese, but the whole culture of like, do you want to protect our country? You know, like, are you going to do this for this? This is for the country, so you have to make this move. So I think there's a lot of
sovereigns with things like nationalization.
Yeah. So there's a lot of like shady things happening, but it's to me bullish shady. it's like bullish, you know, behind the scenes stuff. Like they're gonna keep their interest and bring up the value, right? So I'm an investor. I'm not the politics guy. I'm the enterprise guy.
In that same interview, they also talk about how China's enacting capital controls.
Yeah.
And they won't let Chinese companies take out money from the mainland. That could be very bearish if you're like looking for dividends. As a
So to use that, so to explain that example, right? So what they did was like, let's say the USA, we started printing money like crazy, and and among our culture in the USA, this is for example, we don't usually trust what the government does. And so when they lock us up, they print money, we're going to put into real estate, but they could take our real estate anytime. So if I'm Chinese or if I'm American in this, poor in condition, they lock us up, print money, and I put into assets that they could take any day. I want to take it out and put it into USA assets, or China assets in this case. So yes, capital controls is pretty serious. That's the explanation behind that. These are things that I think one should understand as the way the sovereigns move are completely different from the way a corporation moves. Corporations have to really play by the rules. Sovereigns kind of bend and make some rules. So especially when we look at Chinese stocks, again, the blue chips, I think they're always going to have tailwind from the government. So that's bullish for us investors if we perceive opportunity. Now, a question of them taking our shares, I don't know about that one.
It's like, will your shares ever pay a dividend? And then if they don't pay a dividend, what are they worth?
Right. So I think they do, though. Don't they? I don't track Chinese dividends. Guys, so it is 2 hours. I'll be done in like the next 10 minutes. I do apologize for taking a little bit longer, but that's usually the case. But we'll be done after I review these gold miners, I guess. That's pretty much it. And I got some, we talked about everything. So the last segment to, get everyone out somewhat on time, is the gold miners. So just a quick update. Newmont. I have shares in these, okay? I normally do calls, but I got shares in these. All-time highs. So that's really good. I think it's going higher. Barrick Gold, rounded bottom, breaking the trend line right here, and it's also kind of pushing new highs. I really like that. There's support. This is Barrick, also a blue chip gold miner. Franco-Nevada, again, this is like that hybrid of like 25% silver on top of like 75% gold miner. Again, breaking out, consolidating, breaking out to new highs, also really good. Agnico Eagle hasn't broken out yet, but if the segment's heating up, this is starting to look very bullish right here. It's tightening up, and I think it'll go higher. Kirkland, this one got knocked down because they acquired another company. When you acquire, you spend money. So of course it's going to go down. But it's been holding the 200-day moving average, which looks attractive, as well as able to stair step up. So again, still looks attractive to me. I have calls on that one. KGC is one of the big share size of a famous hedge fund manager named Jim Simons. This one looks attractive as well. BTG, so this is one of my favorites. This one has like a very diversified global gold mines. New highs, what can I say? Really, really exciting news. And then NG, we talked about this one last week, the billionaire who is very high conviction on this security. Yeah, so last week we talked about it, was right here, and then breakout, rounded bottom. I think this one could go higher. Of course, could correct a little bit, but that's anticipated. AGI, another below book value gold miner. Still one of my favorites. I loaded up on some calls and shares, so I have a combination on both of these. IAG, I have shares in this one as well as some calls. It's been choppy, so not much, but hey, it's still holding that wedge right there, that symmetrical triangle. Ego, so Ego is looking good to me. Yeah, I should be having shares in this one, but I don't. But yeah, it's holding that, and I think it'll go up. That's my opinion on that.
Should be having shares in it.
I should be having shares because the thinking is that, well, they look like a total below book value acquisition target for other gold miners. Shares because the thinking is that as gold appreciates, these are going to pay dividends, and it's going to be appreciating dividends. It's going to be really attractive. But options is more an instrument to capture price movements, right? So when I have options on something like a PagerDuty, I anticipate very fast price fluctuation and capitalizing on that fluctuation. Versus dividend, it's like you want to just keep these stocks forever because it will just keep paying you that same dividend because you lock it in. So speaking of dividends, we'll close it out. I have the three. I'm just gonna recap the three dividends that I've been in for like probably more than a year now, right? So MBT paying at one point, I think I locked in at 10%, but we were talking. I positioned in at $8.14 or $8.10. So this is an example where it's a high-paying dividend stock. It's emerging market, Russian telecom, biggest. It's emerging market, Russian telecom, biggest in the space. It's like the Verizon of Russia, paying about, at the time when I locked in, 11% dividend. At $8, now appreciates almost $11, $10. So that's an example of like how you can position in, gain the appreciation, but as well as lock in some dividends, right? Not just that one. AT&T was a really good example. So this is another one where you just kind of buy the shares and look away. This one was paying dividends of 5%. It was probably higher at 6, but now it's probably at 5. So just want to update you guys on the charts. It's looking really bullish. Again, money printing will just cause this one to go higher. SNR is it's a REIT. This one's more focused around real estate for senior citizens. So if you look at the baby boomer charts, they're expanding in terms of like they need to retire out. So it's a great REIT paying pretty high dividends as well. Other else than that, guys, we already talked about PagerDuty. That was like sort of my, I personally think it's a nugget finding in the venture capital space. So I'm going to pay a lot more attention to this one because it looks like another carbon black. I said it. It looks like another carbon black. And if you know carbon black, you've been here long enough, you know what I'm talking about.
Yeah.
So that's pretty much all I got for you guys.
Okay, by the way,
yeah.
just want to, in terms of the end of the year,
yeah.
just want to thank you for holding these sessions, which have been truly spectacular. I mean,
hey, no, thank you, man.
It's been
Yeah.
amazing. And on that note, by the way, so don't forget, by the way, sometimes we talk about the divide in the Bay Area and all that. We're all very fortunate to spend a Sunday here learning from you, but there are a lot of people that are not as fortunate. So don't forget, you have 2 days to make a donation to the local charity of your choice. No, seriously.
Yeah.
I mean, sometimes you got to remember it's giving back to the community too.
Oh yeah.
So there's charities like the St. Anthony's in San Francisco that helps people in need. So you have a couple of days left in the year for everyone. If you're getting value out of this, you're not charging anybody for any of this. Maybe it's time to for everyone to consider instead of paying you for this, make a donation to a local Bay Area charity.
Sure. Hey, why not? I'm a big believer of
pay it forward, man.
Pay it forward, yeah, pay it forward. Train, this is also training for me, so that's why I enjoy doing it.
But it's still, it's great.
Yeah, because when I go out there, if I network with VCs, they're like, dude, are you an investment banker? No, I'm just a lecturer. but it's useful for all purposes. So I hope to help you guys out, and we'll continue to run this.
Fantastic.
Okay, going back to UBS EXY, since it's a depreciating asset,
Yeah.
how do you go along with that?
You buy the shares. That one, there's no options on that one. I think it's just TVIX that has options. So for shares, you just position in shares when it moves. You only play when it moves. You don't want to play when it's not moving, because it's usually just moving down. Yeah. So, yeah. I mean, there's a lot of exciting opportunities here in Silicon Valley. So, yeah, thank you guys for coming out.
Yeah, it's been great.
This is just another week. Another week. No, you're welcome, man. We got more security analysis to do. Yeah.
So you're having another Friday event, or?
Friday, probably in 2 weeks.
2 weeks?
Yeah, 2 weeks. So you guys are, welcome to hang out, chit chat, network. If you have any questions, I know you're new. If you have any questions, feel free to ask. People just kind of network after, or do whatever you like. So. Yeah.
Thanks, man.
Hey, no, you're welcome, man. See you, John. You wanted me to answer your? Okay, we do later. We do later. All right.
Still applying. Yeah.
What are you gonna do today, Fouché? You're coming all the way from New Jersey, man. Are you going back today, or? Are you here for an interview? Project or kids? Kids. I forgot about that one. Hey man, didn't get your name. Chris Brown? Brett Brownthing. Yeah. Okay, nice to meet you. Yeah, Chris Brown would have been like, oh hey.
Yeah. Not too far from
Yeah.